this also makes a lot of sense.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one. If we have a second round, we can come back, and not a speech, just a question, please.
My name is Guowei Zhang. I'm with SIFMA. My question is, as you know, currently category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio, the other one is tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
Okay, I'm going to ask anyone that can address that question, because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios, and I disagree with both of them.
Okay. I'm watching for hands. Yes.
Hi, Sharon Ishai from Morgan Stanley. I actually have a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital to be there for stress. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress where they could be using it to lend and still put on an additional countercyclical buffer on top of that. So it's almost as though the concept behind having overlap is not necessarily taken into account from a buffer mentality where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly think there's simplification and the 2 leverage ratios and overlap between things. That's why this is such a great event today, because the authorities can hear views about how these things interact and whatnot. But I do think my countercyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event. And by lowering by taking out the countercyclical part, you enabled banks to use that capital without running into restrictions on dividends and buybacks and that kind of thing. So our view, and I think as I've read the studies that came out of the March 2020 COVID thing, that for countries in Europe that had countercyclical buffers, they found that the ones that released those buffers had better lending experiences than the ones that didn't. So the whole, maybe I didn't understand quite your question totally, but the whole point of the countercyclical buffer is to encourage lending in stress situations, or discourage having a constriction of credit add to a stress situation.
Alistair. Oh, sorry. Yes, you. Thank you.
Bill Demchak. I'm the CEO of PNC. Just an observation. This entire conversation on leverage ratio and then pointing to the functioning of the Treasury market. What we're actually talking about is the ability of prime brokers to increase their balance sheet in times of stress. So the noise around, hey, banks are just going to go buy more themselves up because they can take more interest rate. We're not going to buy any more treasuries. We can get duration 100 different ways without going to the Treasury market, and we can do it off balance sheet through swaps. What we're simply talking about is it a good idea to give GSIBs the ability to grow their prime brokerage operation to support the actual capital providers into the Treasury market today, which are principally hedge funds. And by the way, I am in favor of that, but I would reduce the conversation to that, because I think our issue ultimately becomes the size of prime brokerage. across Wall Street as opposed to what the leverage ratio is.
So, Bill, would the support for hedge funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that this actually enables the hedge funds to become more levered,
Yes.
because banks, and now you've got a stress hit, and the margins start increasing, and the pressure on the hedge funds, the basis trade blows up even worse.
You're picking your poison, but that is the correct discussion. So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore, right? We used to, we no longer. The hedge funds bid the auctions, the big banks finance the auctions. If you get an off-the-run Treasury that won't trade because it's unfinanceable, you get disruption and dislocation. So you want to be able to finance it. You say, all right, well, I want the Treasury market to function because we're running the biggest deficit we ever had, and it's likely to grow, so therefore I need to get capacity to make this thing work. I need to expand primary deal, the prime brokerage, central clearing, a whole bunch of other things to allow that to happen, all of which I'm in favor for. But I'm simply saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the Treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
I have a follow-up, actually, to Bill's observation.
Could you give your,
sure.
Your name, Pete?
Peter Blostein, PB Investment Partners. So a follow-up to Bill's question is perhaps heretical, which is to ask, are there other rules that should be addressed if we're trying to get more Treasury market liquidity, namely proprietary trading in the Volcker rule? Should banks rebuild relative value fixed income desks that all migrated out of the banks post-Dodd-Frank, post-Volcker, and that should be the place for Treasury market intermediation rather than hedge funds, as Bill suggests? Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any views, panelists?
Well, I think in the context of looking at and taking a look at regulations overall, it's an important holistic piece of the discussion today. I do think in the context of intermediation is one piece of the Treasury market. Certainly that is a very important activity during a period of stress. But to the point of it's a 30 trillion, close to 30 trillion market today, growing. Intermediaries are one player in that market. Buyers and holders across all different banks is something that we need to and should consider to continue to support that market. So that's the kind of broad view, and looking at broadly regulations overall is, I think certainly the leverage ratio is a step in the right direction, but taking that big picture view as part of that holistic discussion that we're having here today as well.
Yeah. Subjected to market risk capital.
Market risk, interest rate risk management.
Interest rate risk management, right.
The proposal does cite some research, for example, by Falk Breining and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to Treasury markets in the March 2020 event. And more recently, a Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that have more headroom under the supplementary leverage ratio provided more financing, to Bill's point, in the Treasury market. So there is some research in support of what you're all saying. Other?
Daryl?
Yes, Hal.
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the Treasury market. It's the implication. Okay. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about while we're even doing this. If prop trading would help the Treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question.
Darryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are. Al?
Darryl. All right.
Sorry.
Norbert Michel, Cato. Hi.
Yeah.
Sort of an efficiency question along those same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about the capital at the IDI level as opposed to holding company level?
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you have your light on.
I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now Al.
Sure. Thank you. Al Moffat, JP Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the Treasury market. And one thing I haven't heard from the panel is the effect on deposits. And so one of the things we saw during the periods of QE was that there was significant growth in deposits prior to the Fed rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. And I'm just wondering if the panel has any thoughts on the role of, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low-risk activities like that, even if they are put into cash and not 30-year Treasury bonds. And just, maybe that potentially offers flexibility for the Federal Reserve in the size of the RRP program. But welcome any thoughts.
Who has a thought about this? Ben.
I was going to say the economic analysis of the proposal makes very clear that just in the past years and probably over longer periods, the degree of low-risk assets, treasuries, reserve bank deposits are much higher now than they've been in historical past. And I think that's important for the ESLR. It's also important for the basic Tier 1 leverage ratio. They have 4%, 5% structure, and the prompt corrective action framework's been around for a very long time. When it first was implemented, I would be very confident that reserve bank balances and treasuries were a much smaller portion of bank balance sheets. Thinking about the overall structure of the capital framework, looking at the evolution of bank balance sheets, the degree of low-risk activities that are related to deposit taking, liquidity risk management, I think it's a very important consideration.
Tiffany.
I agree. As you mentioned, Al, heightened cash balances, heightened deposits, particularly in a period of stress, it typically coincides with when also Treasury intermediation is important. But ensuring, which is why we talk about a targeted approach that specifically excludes cash, for example, because banks tend to be that shock absorber of cash and deposits, whether it be in the immediate stress or afterwards as a result of monetary or fiscal policy. And banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the Tier 1 leverage ratio should also focus on that.
Yes, and I think just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE and adding to those deposits that you were talking about. And that's at the Bank of England. We exempted deposits at the Bank of England when we wanted to make sure that was. So I think. So as I said, I would be opposed to exempting Treasuries blanket, but I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
If I could, I just have a quick add-on that ought to be part of this discussion, and that's FDIC insurance on size of your balance sheet. They're the only measure still left where you go period end. And so one of the reasons you see repo get very tight at the end of a month is simply because everybody's calculating their balance sheet on period end. If they averaged it, you'd likely get rid of the month-end crunches. It seems to be a pretty easy fix.
Good to know. Okay, so we've run our allotted time. I just want to thank the panel for an extremely illuminating discussion. Lots of back and forth, good audience participation. I learned a lot. And I want to thank Vice Chair Bowman again for inviting us to speak here today. Thank you.
All right, we'll get started in about 30 seconds. So if you haven't taken your seat already, I ask that you please do so.
Good morning. My name is Jonathan Gould. I'm the 32nd Comptroller of the Currency. Although I was sworn in less than a week ago, it's great to be here. And I look forward to engaging on these very important issues going forward. I greatly appreciate the range of perspectives and views that are being presented here today. And I thank the Vice Chairman for Supervision for her efforts in this area and her invitation to attend today's event. One of my areas of focus as Comptroller is ensuring regulation and supervision are properly calibrated and appropriately focused on safety and soundness. To that end, I believe it is prudent to consider the appropriate risk tolerances and capital requirements that are required for the largest banks, and how these choices may impact other banks as well. This next panel is focused on the evolution of the capital framework, including what has come to be known as Basel III. This distinguished panel will share their thoughts on several topics of interest, including the global framework, tailoring, interactions with other prudential requirements such as stress tests, and the impacts on economic growth and financial stability. I'd like to thank our distinguished panelists for appearing today and would like to turn the discussion over to panel moderator, the inimitable Rob Blackwell. Thank you.
Thank you very much. Thank you very much, and thank you to Fed Vice Chair Bowman for having this conference. This is very exciting. I have a wonderful panel in front of us. I am not going to do justice to any of their biographies. That way we can get straight to the questions and presentation. But so that we'll give you a brief overview. Phil Evans, to my left, is Director of Prudential Policy at the Bank of England. As part of that role, he's in charge of implementing Basel Endgame in the UK, called Basel 3.1 there. He previously was in charge of coordinating the bank's work on the UK's withdrawal from the European Union. Shira Friedman is the Chief Accounting Officer and Controller for Goldman Sachs. As such, she is responsible for the oversight of external and internal reporting, product control, and regulatory capital. Randall Quarles is the Chairman and Co-founder of the Synosia Group, a Utah-based investment firm. He was the first person to serve as Vice Chair of Banking Supervision at the Fed, serving that role for 4 years between 2017 and 2021. Last and not least is Mike Mayo. He's Managing Director and Head of the U.S. Large Cap Bank Research at Wells Fargo Securities. He is the first analyst to testify on the causes of the great financial crisis, and he is representing himself, not the views of the bank. So I'm going to actually kick off right. I just want to make that clear from the outset. I'm going to kick it off, and you'll see why in a second. I'm going to kick it off directly to Mike, who's going to give us an overview, a brief overview, but very entertaining overview of how we got here. When we talk about Basel Endgame, what are we looking at, and how did we end up in this place?
Well, Rob, thank you, and thank you to the board.
The mic button. Sorry. Mic to the mic. Yeah, it's the button with the voice.
Oh, it's the big with the mouth. Yep. Okay, there we go. Look what I found in the hallway as I came. Look, I love the idea of a regulatory reset. Let's keep banks safe and sound, but rip out as much bureaucracy and red tape as possible. And so I'd start with, first, thank you, regulators, for what you did after the global financial crisis. You made the system so much more strong than elsewhere around the world, and I'll spend 2.5 minutes on these. But the system today, it's too confusing, too constraining, and too costly. And when I worked here in this building 35 years ago, the capital rules were simple and weak, and today they are complex and strong, so let's make them simpler and strong. And I did a proprietary survey to institutional investors. Those are the largest pension, hedge funds, mutual funds around. And 9 out of 10 investors, these are the owners of the banks, find the capital rules confusing. There's too much regulatory risk. Regulatory risk wasn't even a phrase a few decades ago. There's other risks you have to contend with, not the 4 words that strike at the heart of investors. What will regulators do? There's too many targets, it's acronym soup, and too much capital volatility. It's too much of a black box. You don't know the cost of goods sold until after the fact. I mean, if you're selling steak au poivre and you don't know the cost of the steak till after that's a problem. Look, nobody wants to go back to 2007, but right now the pendulum swung too far. Same investor survey, 9 out of 10 investors find regulation too strict. Too much marginalization of banks. If you look at loan growth by decade, the last few years it's been flat to negative, inflation adjusted. Too much disintermediation, marginalization of banks, too much business leaving the banking system. And too much disregard of de-risking. 15 years. You've done a great job, regulators, as of 10 years ago. You've doubled capital roughly. You've doubled liquid assets. Banks have not stretched for loan growth. But as I learned here, I learned my best lessons here at the board 35 years ago. If it grows like a weed, maybe it's a weed. Banks have not been growing loans like a weed. And look at what the $7 trillion investment-grade bond market says about bank safety. They're saying banks are safe. In fact, they've said banks are safe for most of the period for the last decade. And it's too costly. These are our best estimates, but roughly 20% of bank expenses are related to regulatory, compliance, cyber, all in. And then when we poll large banks, they think they could maybe save 10 to 20% of that. So you're looking at a possibility of saving 4% of expenses. And in our investor survey, what investors are looking for are greater efficiency from regulation and greater loan growth. And there's too many moats around the largest banks. Talk about unintended consequences. By the way, when I worked in the application, the merger group here 35 years ago, we would approve mergers in 60 days. And we had one review said I looked at 100 applications in a year or something. And the unintended consequence is, fine, I'll just keep increasing my price targets on the largest banks. We should have more trillion-dollar banks to compete against JP Morgan. Goliath is winning. They're gaining share. And then there's the loss of talent. For every executive that comes in the banking industry, 5 are leaving. Talent drain. So 10 unintended consequences, too much regulatory risk, complexity, targets, volatility, marginalization, disintermediation, expenses, loss of talent. But there's hope. Let's see if this works here. The hope is this. I had to bring children's scissors to fit through the metal detector in the airport. Well, this is the hope, okay? That's the hope. And the end result here then is just win, win, win. Regulators, you can have more efficient oversight. The banks, yes, they'll be more profitable, more efficient, but the customers will have better terms and more options. So with that, I was going to hand this over to Phil, who can describe how we got to the state in Basel III.
Oh, blimey, I think I'm going to be a bit less entertaining than that. So I thought I'd take this two ways, basically. So I talk first about the benefits of having a kind of an internationally aligned approach. What benefits does that give us in general terms? And then I'll get on to the specifics about why this Basel Endgame package is, why are we doing it? So on the general, and I guess this is one of the key points I wanted to get across today. I mean, I'm going to argue that international standards are things that we benefit from. The reason we do them is we get benefits. And there are many that you could talk about. The two that I would pick out are, in terms of, first, international financial stability. So we are and still remain so interconnected that when something goes wrong globally on financial stability, it affects everyone. And those costs are deep still. And the second is on the role of international standards promoting trade in financial services. So, large global banks have economies of scale and scope, and part of the way they get those is having similar rules across borders. So it's what allows domestic banks to operate abroad and foreign banks to operate domestically. So that's the general. What about the specific on Basel Endgame? So as Rob said, our version of that is called Basel 3.1. So we couldn't quite bring ourselves to call it Basel 4, and so we had like a tiny eeny weeny Basel 3.1. But my guess is we were looking for the same kind of comfort blanket that you guys were when you called it Basel Endgame. It's part of the post-GFC reform package, so it's the third bit. First two bits were about the quantum of capital and then the quality of capital. So quantum we've done already. So I don't think that the Basel Endgame package needs to be about the quantum of capital at all. What is it about? It's about measuring risk better, right? So the standardized approach we have at the moment, the standardized approach is always going to be blunt, but it's just very blunt, the one we have at the moment. And so we're kind of tilting it just so that it picks up risk better for the right activities. And that is important in its own right, but it also has benefits for competition, because one of the things that we feel strongly in the UK is that smaller banks have been unable to compete on low-risk activities because they're forced up the risk curve by this very blunt standardized approach. And so a big benefit is to improve competition. On the model risk weight side, we kind of lost confidence in that a bit. So we had these papers post-crisis where we were running experiments. We gave firms the same, exactly the same scenario, run it through your models, and they throw out completely different risk weights. And that kind of drains confidence. So one of the things we're doing in this endgame package 3.1 thing is a bunch of things to try and bring back some of that confidence again, so, through things like the output floor. So I'd argue there's a lot to like about international standards in general because they give us benefits, but this particular package is balanced and gives us some good things.
All right, well, thank you very much. As everyone in this room knows, this is not the first time we've taken a run at Basel Endgame. So I'd like to ask Randy to start off and give us a sense of what were the mistakes that regulators have made in the past? What are things that should be avoided now as they craft this again?
Well, I guess it depends on when in the past you're talking about. Because there have been a few efforts, and some were better than others, as it turns out. But so I think there are, with respect to what ought to happen in finishing the implementation of Basel III, I think there are substantive issues and there are process issues. The first substantive issue is that these measures, even in Basel, as Phil mentioned, this isn't about the quantum of capital, and it was not about the quantum of capital when these measures were being discussed in Basel. It's about the incentives that the overall capital framework is creating, and they were not intended to increase the quantum of capital, and I think that should be a first principle of implementation here in the United States, not just because it's sensible, it's also Basel compliant. It's not intended to increase the aggregate amount of capital in the system. I think, and there have been proposals around implementing Basel III that would have done that, and I think that, I think that was the wrong direction. As a matter of process, I think it is a mistake not to get as much input as possible. And so this conference is a paradigmatic example of how one ought to go about the process of the implementation of these last measures of Basel III. From all sorts of areas. More heads are better than one. I think there have been folks who have said, look, here's a proposal. If you don't like it, vote no. And that's it is a better process to have gotten input from everybody in this room, folks outside of this room, academics, banks, public interest. I think banks are part of the public interest, but a wide range of groups. And I think if you combine those basic principles, then there can be a successful result. I would add that I do think there should be a successful result. I've heard, there have been threads over the course of the last several months that maybe we just drop these last measures of Basel. And I think that's not in the interest of the United States. Bill makes a good case for, global financial stability. I used to be a global financial stability guy. I have nothing against global financial stability, per se. But the Basel process, particularly the Basel capital process, has really always been in the fundamental interest of the United States. Hal Scott mentioned that the very first Basel was because the Japanese banks were being allowed to operate with $12.73 of capital, and they were hoovering up all the business in the world, literally all the business in the world. Those of you with gray hair around here will remember the late 80s, and it was like US banks could not compete because the Japanese banks did not need to have any material amount of capital. And so the first Basel effort was to say, globally active banks will have globally consistent capital levels. Now that was, it was crude and simple, but it was a first effort. Then during the 90s, the European banks were operating with much less capital than the American banks, and so Basel II was this complicated effort to create an intellectual framework that would justify allowing the US banks to lower their capital to the levels of the European banks. The math club went to Switzerland. It was extremely difficult to understand, but people felt confident at the end that the capital could come down. No sooner was that done than you had the great financial crisis. Whoops, wrong direction. Capital needs to come up instead of down, and Basel III has been ensuring that particularly the Europeans, but global capital levels in general, are consistent. If you don't like what's coming out of Basel, what I say to the folks who wear my political football jersey, who believe that we go into these fora and are snookered by the wily Europeans, it's like, that's not what happens at all. If you don't like what is coming out of Basel, it's because you don't like what the US took into Basel. We generally get everything we want out of Basel in order to create this level playing field. And if we didn't have Basel, we would all be subject to these same rules because that's what we took in. And the rest of the world would not. So I do think it's very important that following these principles of not increasing aggregate capital, doing it in a sane and smart way, getting a lot of input on the technicalities, that we do finish the implementation of Basel.
Well, thank you. Shira, do you want to weigh in on where you think the mistakes were in the past?
Sure. Thank you very much. And I agree with everything that my other panelists have said. I think it's important to take a step back in light of the history journey that Randy just took us on and recognize that what is attempting to be done in Basel III Endgame is what's transpired over the last 4 decades and 4 iterations of changes to the capital framework, in that it addresses every component of the risk-weighted asset calculation and the ratio construct themselves. So it's a significant book of work, and some could argue the most significant book of work. And in my mind, there were 2 flaws in the design of the original NPR, both of which relate to isolation. The proposal was done in isolation of the other components of the capital framework, and the proposal was done in isolation relative to what was being done internationally. So as it relates to the capital framework, what's unique with the United States relative to every other major jurisdiction around the globe is that the stress capital buffer is a Pillar 1 requirement, which means it's included in your capital ratio requirements. And therefore, when you're going to overlay Basel III Endgame with the stress capital buffer, you need to be extremely mindful of the capitalization included in each affecting the same asset class or markets or products. And it didn't appear as though, based upon how the NPR was proposed, that that was done to a sufficient level. So that's one component of where it was done in isolation and I think didn't calibrate correctly. The second is it was done in isolation relative to the rest of the world. And there are components that was included in the NPR that no other jurisdiction in the world implemented. So for example, the SFT minimum haircut floor was included in the NPR. No other jurisdiction has implemented it. The public listing requirement to get an investment grade rating was not implemented in any other major jurisdiction in the world. And so as a result, it's not surprising that 97% of the responders to the NPR were against it in some way, shape, or form. So the good news, and part of it is the energy that you're feeling in this conference, is the Federal Reserve has the opportunity to repropose Basel III Endgame, and I agree with Randy's statements that it should be on the docket of the many things that Vice Chair Bowman needs to do. But the good news is Vice Chair Bowman specifically has discussed the importance of looking at capital holistically and the relationship between all the different components. And then from an international perspective, because most jurisdictions are further along in implementing Basel III Endgame, you know the answer as to what every jurisdiction around the world has done, and that can kind of start as the blueprint as to how the Federal Reserve wants to repropose.
Well, thank you for that. I think since it's entitled The Evolution of the Capital Framework, I want to know what would a successful Basel III Endgame final rule look like? I mean, how would we know if we'd succeeded in what we're attempting to do here?
I'm happy to start and others can weigh in. Every time a new capital rule is put into place, whether it's in the US or internationally, what essentially is being balanced is safety and soundness versus growth, innovation, capital markets, et cetera. And so in theory, you're weighing, and the regulators are weighing those two things in making all of the decisions around capital implementation. And so to the extent that the only thing you cared about was safety and soundness, you could make banks hold infinite amounts of capital. And as a result, you wouldn't have to worry about safety and soundness. But what would be the other side of that? Corporate bond underwriting would come to a screeching halt because there would be nobody available to underwrite. Corporations that want to hedge their interest rate risk or their commodity risk or their FX risk have no counterparties that they can face. Mortgage lending, credit card lending, et cetera. And so it's really about striking that balance between economic growth and safety and soundness. And so when you look at the way in which most other jurisdictions have implemented Basel III Endgame, they've really tried to achieve that balance. And in some ways, it comes back to that capital neutrality point. And so there are certain components of the rule that they've implemented that incentivizes economic growth. As an example, most jurisdictions have exempted end users from the CVA add-on included in Basel III Endgame. And that's to protect those corporations from the burden of the banks carrying increased capital associated with facing them as a counterparty. Many jurisdictions have not applied the 400% risk weight to public equity, to private equity, to all private equity, but limited it to speculative private equity so that banks can continue to participate in more mature private equity, which is often on the precipice of them ultimately becoming public equity. And so to me, a successful Basel III Endgame has appropriately balanced safety and soundness, which is obviously incredibly important, but also economic growth.
Randy, do you have a view? What does success look like?
I think that was a pretty good overview of what a successful implementation would look like. The purpose of these last measures is to create incentives with respect to bank activity without increasing the capital burden, if you will. And I think if you see bank activity modifying appropriately in light of the areas where these new capital requirements are being implemented, in a way that is supportive of economic growth, but you actually see, okay, well, the banks are changing their, we have in fact created incentives. We're seeing that the incentives are operating appropriately, and we haven't increased the overall capital burden on the system. That's a success.
Phil?
Yeah, I mean, the best way for me to answer that is to couch it in terms of the way we tried to construct our own implementation of this. So I guess there were three things. So one was from the bottom up, activity by activity. We weren't looking for too little capital, but we weren't looking for too much either. So that a kind of fair amount of capital, if you like. And then top down, we had a view that there was enough capital in the system, so this wasn't meant to be about looking for more capital overall. And then third, we were looking for international consistency. So we were monitoring what other people, what other countries were doing. So what does a good one look like? I think it looks like those things coming through. So the playing field looks level. We've got consistency across jurisdictions. We're looking to make sure that capital isn't rising. So one of the things we'll probably get onto this when we talk about stress testing, is we had a principle from the beginning that we shouldn't double count. So if there was something where we were holding capital previously in some part of the stack, and now Basel 3.1's coming in and you're holding it in Pillar 1, and it's the same thing, then you don't need to hold the capital twice. And that was a principle that we tried to build in from the bottom. It's easier said than done sometimes, so it's not always obvious what is a double count. Final thing I'd say, so I do think there's something in this for small firms. So the risk sensitivity that I mentioned, I think, is a good thing for small firms on the standardized approach. And I'd like, so I think we'd be looking for in our implementation just a bit of the leveling the playing field between small and large firms. That's it.
And most importantly, less loans to the shadows.
I think one of the things that, Randy, you just touched on was this idea that what happens if the U.S. doesn't complete Basel III Endgame, and there have been some lawmakers who are concerned about the international framework as if we're deferring to international regulators of what to do here. So let me just ask each of you, what happens if the U.S. just decides not to implement Basel III Endgame and lets it go?
Yeah, an important question. I mean, I guess the first thing to say is I hope that doesn't happen because so speaking for the UK, we get tremendous value from our close collaboration with our US counterparts. It really does make a difference to have the US as an integral part of the international community. I guess a bit more concretely though, so I haven't really seen evidence of that, that it's particularly likely. So like my reading of the consensus is that it doesn't seem very likely. And I guess at one level, I don't find that surprising because in the way Randy and I have tried to describe the benefits of kind of being similar across jurisdictions is good for global financial stability. It does help with leveling the playing field. And, you know, these are all things that we recognize, that the US recognized when this was being negotiated in the first place. So I'd argue that banks, large US banks, as well as UK banks, benefit from that consistency. So you'd want to do it, I think is what I'm saying. So all of that explains why we're a long way down the track in terms of our implementation. But so, I mean, given those arguments, if the US really didn't implement, obviously that would be a major issue. And I think it would be wrong to deny that it would be a major issue. So although I think there are strong drivers to get Basel Endgame done, you know, we'd have to cross that bridge when we come to it. But I know the US authorities that we speak to anyway understand that very well.
Sure.
Yeah, I was just going to kind of agree with my panelists. I think that although my perspective is obviously different as a practitioner, the importance of having the banks around the world on a similar and consistent capital framework, recognizing that it can be gold-plated in some jurisdictions versus other, and on all things that need to be addressed and discussed, that I do think that it's important that the U.S. implement Basel III Endgame to be consistent with the other banks around the world.
Randy, anything to add to what you said earlier?
Yeah, I think the principal consequence would be when we get to Basel IV, which we will There will be new issues in the future. We will learn things about the financial system will evolve, the banking system will evolve. There will be a need to evolve the capital framework in light of that. Other issues will arise, and we in the United States will once again say, if we want to have a fair playing field on which to compete, there are some changes we need to make, and we want them to be made consistently. And if we have not implemented Basel III, which was very much driven by the United States, we will walk into that room and people will be much less willing to listen to us, since we were the Lucy that pulled away the football the last time.
Mike, do you have anything you want to?
Get it done, get it done, get it done. If you don't, then the cost of capital for banks would be higher than it otherwise would be.
So I want to spend a little time. There's an entire panel about the stress test, and I don't want to steal their thunder, but I do want to talk a little bit about the interplay between Basel III Endgame and the stress tests, and what the relationship should be. So Shira, let me start with you. What should the relationship be between this?
Sure. It's a great question, and it's something that gets a lot of discussion. As I mentioned earlier, the U.S. is unique in that the stress capital buffer is part of our Pillar 1 requirements, or part of our ratio requirements, and therefore requires a higher degree of sophistication when combining that with Basel III Endgame, because you have everything that's been capitalized in the CCAR stress test, and then you have things that are being capitalized for in Basel III Endgame, many of whom are double counts across them. So in my mind, the most egregious example is operational risk. In the results that the Federal Reserve released last month on the CCAR stress test, they included $180 billion of capital associated with operational risk losses on the banks that participated. And so therefore, that $180 billion has been capitalized for in the bank's ratios. When included in Basel III Endgame, it reintroduces operational risk into the risk-weighted asset framework. Currently, today, that only sits in the advanced ratio, so it's not part of the standardized ratio, which is the more binding ratio for the banks. And so included in Basel III Endgame is operational risk-weighted assets. In the estimates that the banks provided in conjunction with the NPR, the amount of capital associated with those operational risk RWAs was around $150 billion. And for those that don't know, operational risk is capitalizing for, generally it's legal losses, that's kind of the biggest driver, but it includes any sorts of costs associated with outages, climate-related events, et cetera. It's all captured in there. So when you take the stress capital buffer loss of $180 billion, plus Basel III Endgame RWAs of operational risk, which is around $150 billion of capital, what the original proposal did is just put those two numbers on top of each other. And so the question that every constituent should ask is why is it necessary for banks to hold $180 billion plus $150 billion of capital associated with operational risk? And if you look at history and just focus on the GSIBs, over the last 10 years, so decade, the GSIBs, and I can only speak to legal losses because operational risk losses are not in the public domain. The GSIB legal losses has not been $180 billion. It's not been $150 billion. It's been less than $100 billion. And that's over 10 years. The CCAR stress test is only 9 quarters. And so I use that because, again, I think it is the most egregious example. But you can look at market risk. You can look at CVA. You can look at lots of different components. And the challenge for the Federal Reserve is to look at what's being capitalized for in the stress capital buffer, which is unique, and what's being capitalized for in Basel III Endgame, and making sure that they're not double counting things.
Randy, the stress capital buffer was finalized under your watch at the Fed. Can you take us through why it's better than the CCB was and why it's needed now?
So I think that there are two parts to that answer. One is a legal part, sort of general legal principles part, and the other is a practical part. So before the stress capital buffer, and I hadn't realized this until I walked into, well, it wasn't this building, it was the one across the street, which now may never be built, but before the stress capital buffer, the outcome of the stress test, the practical outcome of the stress test, depended on what the Board of Governors had had for breakfast on the morning it was presented to them. And that does not seem to be the right way to operate a regulatory system. That's going to have such consequences for the regulated. So the basic legal principle, it seemed to me, was that the consequences of the stress testing process should be clear and concrete and measurable. They should be legal as opposed to entirely discretionary. And I should state that I'm a big fan of stress testing. During the COVID event, the fact that we had stress tests, and we ran 7 stress tests in the United States during that period, allowed us to be very confident in the resilience of the banking system during that whole time, and allowed us to continue to allow our banks to pay out dividends when the rest of the world had suspended them. And our banks are benefiting from the lower cost of capital that comes from that predictability of return even today, many years later. So stress testing, good in general. But there should be a predictable outcome. The practical side of the question to me for the SCB as well is that if it depends on what you have for breakfast, different people at different times have different breakfasts. And the potential consequences of the same stress testing outcome, depending on the particular people who have been appointed to the Federal Reserve at any point in the future, could be dramatically different. If you've left that open, you've essentially left it open to the vagaries of the political process if you don't have a concrete consequence for the outcome of the stress test. Over a long period of time, the Fed is a marvelously apolitical institution. As a citizen, I've been very, very pleased with my involvement with it to see how true that is. But the people are appointed through a political process, and over a period of time, you could have significantly different outcomes for the industry. So I think both for general legal principles of regulatory action should be subject to discipline, and the stress capital buffer makes it clear what that discipline is, and and predictability of results over time. That's how the outcome of the stress test should be implemented, is through some sort of a stress capital buffer.
Mark, you look like you have something you want to
Well, I just want to put an exclamation point for what Randy said. I mean, having had the stress test in April 2020 or spring of 2023, we felt confident, I think a lot of investors felt confident, that banks could withstand whatever was coming their way, the largest banks.
If the agencies agree that the fundamental review of the trading book plus the GMS and the stress test hit bank trading books with excess aggregate capital requirements, what is the best path to reducing that surplus? Should we soften the GMS or look to soften the FRTB domestically or in Basel? Shira, you want to? I'm gonna volunteer you because you have the red light on your microphone.
I heard FRTB, and that's like magic to my ears. So I figured it was coming my way. My takeaway from Randy's talk as it relates to how the SCBs are derived is that I should have gone to culinary school instead of becoming an accountant. Would have been better for Goldman Sachs. But with that said, the FRTB, and for those that don't know, that stands for Fundamental Review of the Trading Book. That's the market risk component of Basel III Endgame. And the Global Market Shock, or GMS, which is included in the CCAR stress test, is the instantaneous shock to the trading businesses of the largest banks. And so your question underlies the issue at hand, which is that there's a duplication between how FRTB is shocking market risk and capital and requiring capitalizing for market risk versus the GMS. And if you dig even deeper, they both kind of do it in a similar-ish framework. They're both looking at the same position set, and they're looking at tail risk, so they're shocking it to like the very tails in terms of how those markets would be affected. And then, again, in the original proposal on Basel III Endgame, stacked those two things on top of each other. And so to your question, to the extent, as the Federal Reserve is looking to repropose Basel III Endgame, as well as, all the work that's being done on the CCAR process, I think both stand to benefit from a really deep dive to ensuring that the shocks and the assumptions and liquidity horizons that are being used in them are consistent. And I'll use an example that I think highlights it. The GMS still uses assumptions from the financial crisis in terms of the level of shocks, despite how far we are removed from the financial crisis, and more importantly, how much reform has happened since the financial crisis. So as an example, using securitized product, so this is the underwriting and packaging of mortgage-related or asset-backed or CLOs, taking all those assets together and issuing them as bonds. The shocks that the Federal Reserve applies in the most recent CCAR stress test, so the one that we just got the results of, are equal to the shocks that banks, that those assets suffered during the financial crisis. What that doesn't account for is the fact that the LTVs of those loans are significantly different. The FICO scores of the borrowers are significantly improved. And so the shocks are being applied to bonds and assets that are much better underwritten or subject to much better underwriting relative to the products that were being traded in the financial crisis. And so I do think that the GMS is very ripe for that, to get that overhaul, because it really hasn't been addressed, since it was first put in place. And one of the ways in which the calibration is off is to the extent that you take an asset, a securitized product, and subject it to both FRTB and the GMS. About 15% of the product that was underwritten last year, banks would be required to hold more capital than the carrying value of that asset. So I would have a bond with a carrying value of $100 million, and if I added FRTB and the GMS to it, I would capitalize that for $120 or $130. So the capital that I would hold is greater than the carrying value, such that if I wrote that bond down to zero, I'd actually release capital. And so it's an example of where you can look at it quite simply and see that the calibration is off. And as I mentioned, this isn't one or two bonds. This is 15% of the market that was underwritten last year.
So one of the arguments that Treasury Secretary Scott Bessent brought up last night was talking about whether or not firms should be able to opt in to Basel III Endgame, those that are not covered by it. And I guess I want to get the panel's view on, are there pros and cons to including them versus not allowing them to be included if they want to, and what the system looks like?
I'm a libertarian. And I'm nobody's mother. I mean, if they want to opt in, I don't see a downside, except potentially from the institution, and that's theirs to judge.
Phil?
Yeah, so this is a question about whether you apply the rules to small banks. So Basel 3.1 was agreed internationally, so clearly applies to the largest banks. I've argued that it's better than what we have now, so I think you'd want to apply it to mid-sized banks for us. The question is, do you apply it to the very smallest banks? And so in the UK, we've long wanted to have a kind of a more proportionate regime for smaller banks. And now that we have left the EU and we can write our own rule book, we've been working on that. So we call it strong and simple. In homage to Mike. So we had to decide whether to take Pillar 1 from Basel 3.1 and give it to the very smallest banks. In the end, we decided we would because we just felt it was better. We felt it enabled them to compete more. The caveat was that where we saw that there were parts of the new Basel framework where they just didn't need the rules because they didn't do much of it, like trading book rules, CVA, counterparty credit risk, all of that kind of stuff. We said, you don't do much of that. That's how you got into the strong and simple regime, and so you don't need to worry about those rules. So we carved them out of that, but the rest of it we did. So we have. I think it is possible to give the Pillar 1 to smaller banks, and I do think they would benefit from it.
One of the things in my former life when I was editor at American Banker, we used to talk a lot about capital standards always inadvertently pushing banks out of different activities. So, can you talk about the extent to which there are dangers in Basel III endgame of doing that versus, how can we morph capital requirements to bring some of the activities that were in the past possibly pushed out by these capital requirements back into the system?
I'm happy to start, and others can weigh in. I think that your question is 100% right, and we've seen it time and time again. No matter how big or how small the rule is, as the capital framework continues to evolve, you're able to pretty clearly see the impact of what it does to the broader market as a result. So when, mortgage lending related requirements were gold-plated, you immediately thereafter saw an uptick in the amount of mortgages being underwritten outside of the banking system. Most recently in the implementation of SACR, which is the counterparty credit capitalization requirements, which is actually part of the Basel III endgame, those rules changed the capitalization for short-dated derivative hedging. And as soon as that rule came into play, you started to see that activity move outside of the regulated banking system. And so that unintended consequence of the amount of activity kind of almost immediately responding. I mean, you even see it in CCAR shocks, where if in a particular year the Federal Reserve shocks are more punitive to something specific from an asset class perspective, you will see banks will do less of that and it will move outside of the regulated banking system. And so that's something that needs to be really carefully thought about in conjunction with all the components of the capital framework that the Federal Reserve is looking at, whether it's the stress test or Basel III endgame or GSIB, that to the extent that you're increasing the capital requirements on particular products for the most highly regulated banks, that activity will go somewhere and it will go out to the less transparent outside of the banking system.
Randy?
Yeah, I do think that is something that has heretofore across a broad range of eras and people and regimes been given insufficient attention in thinking about bank regulation. Is that especially in the United States, but now really even very substantially globally, it's a financial system, it's not just a banking system. And if we adopt regulations that are going to push something out of the banking system, it will go elsewhere. We will not really constrain that activity. You have to think, and we will push it into either parts of the financial system that are less transparent and less well capitalized, or jurisdictions that are less transparent and within the banking system that are less transparent and less well capitalized. So, and there really has not been sufficient attention, I think, given to that holistic view. The growth of private credit in the first instance was really driven by regulation. I think it's now growing for reasons that are outside of regulation. I think actually there are reasons to think that the growth of private credit is probably stability enhancing because the vehicles through which private credit is provided are less subject to runs, and an ecosystem is developing where the banking system and the non-bank private credit system are working together in a way that allows more visibility from the bank regulators into the overall financial system. I think it's working well now, but there's the fact that it's working well, there's no particular reason to have driven it out of the banking system, and the bank regulators should think about, if a bank can do this lending safely, it should be allowed to do it safely, even though the private credit system is not, in fact, I think, harmful in any way.
Well, we have a brief few minutes before our panel ends, so I have more than enough questions that I can keep going, but trust me, question right up here in the front.
Thanks. I want to take us back to some of Mike's slides in the beginning, where you painted sort of a picture of utopia, a city on the hill that would be both strong but simple. So if you were going to try and move us from where we are today towards both simplicity and strength, are there one or two things you say these would be the best moves to get to that city, both for Mike and for others?
Well, I call it balls and strikes. I don't set policy. So I'll let you know once I see it. But you know, when I talk about it being confusing, it's not just confusing to investors. I bet it's confusing to bank board of directors too, and bank execs, and frankly, probably some regulators. When I talk about it being constraining, you know, let's banks be banks. When I talk about it being costly, I mean, that's an easy one. I mean, we all see examples of that. But I think, you know, two themes have come up. Certainly holistic approach to capital. Second is the idea of level playing field. But I'd add a third one, and that would be dynamic regulation. Because we're going to have more bank failures. There's going to be more bank crises. You know, that we all know that. But they don't repeat, right? You had lending to South American countries, and then you had commercial real estate, and then you had long-term capital, and then you had global financial crisis, and then you had Silicon Valley, and the next one's going to be different. So I like the idea of having examiners also being accountable in a decentralized way as opposed to ivory tower academic setting models. So I think a degree of humility about what we can do. And when I was here 35 years ago, there was Bill Taylor who headed bank supervision regulation. He was the best. And he was like, you know, be tough on the things that matter. That's capital. That's liquidity. That's what keeps you solvent. So that's my template for it. But I'll leave it to the ones who practice and do these things for the policy.
The good news is, you know, we're having a conference like this like we've never had before. And when you look at what Vice Chair Bowman's done over the course of the last few weeks, it's more change than we've kind of seen in both the recent past and even longer. You know, I think focusing your question particularly around the CCAR stress test, you know, we are pleased with what the Federal Reserve has done thus far in terms of enhancing some of the disclosure around the tests and also talking about their willingness to put the scenarios and the models out for public comment, because we think that transparency is really important. As the firm with, I would argue, probably the most volatile stress capital buffer, I agree with Mike's points. You can imagine capital planning is very difficult when your requirements could change year over year by north of $10 billion, even though your business model is relatively consistent. And although the averaging NPR is meant to address that volatility, it doesn't actually address the fundamental or the root cause of the problem. The root cause of the problem is the scenario and shocks, which we've talked about, that really haven't been calibrated for all of the regulatory reform, the Volcker rule that we talked about in the last panel, mandatory margin and clearing, and all of this uplift that's been done to the regulatory environment, such that the shocks that existed in the financial crisis shouldn't be the shocks applied today. And then the models, again, we don't have full transparency around them, although we look forward to that, don't respect some of the observed correlations that exist that we've seen it happen time and time again. Example around trading revenues. All the most recent crises have proven that in times of volatility, trading revenues increase because there's more activity and bid-offer spreads widen. Nevertheless, when the Federal Reserve models trading revenues in stress, they don't include that assumption. And so I think that we're on a really great path, but that's some of the more particulars that need to get addressed.
Jarrett, over there.
Yeah, hi, Jarrett Seberg with TD Cowen. I'm going to regret saying this on camera, but I actually agree with Mike that I think most of the market doesn't understand bank capital rules. And I think we run into a problem where there's such a push for tailoring. We hear that over and over on Capitol Hill. But that means that we have even more sets of rules, and we don't quite know which banks apply, are covered by which sets of capital rules. I wanted to focus in particularly on available for sale securities and whether those unrealized gains and losses should run through capital. I was hoping the panel could talk a little bit about why that's only for the biggest banks, and should it be pushed down to all banks?
That's a good question. Does anyone want to jump in there first?
So it's, I probably shouldn't have pushed that button because it's been because it's been a few years since I engaged on the question. But it's harder than it sounds because to the extent that you push changes in the available for sale securities account through capital, then you create a strong incentive to move those securities to the hold-to-maturity account. And once they're put in the hold-to-maturity account, they are, as a practical matter, quite illiquid. So when the Federal Reserve, this was long before my time, this was under the Saint Dan Tarullo's time, considered this question, that incentive was very important in saying, okay, well, we shouldn't do that for most banks in order to create this kind of incentive for structural illiquidity on what should be liquid securities. Of course, the problem is that those available securities do change in value, and that can have a capital effect. If you take, however, Silicon Valley Bank just as an example, where that was the most recent instance where this issue was considered, and people said, well, why shouldn't we have been requiring them to increase capital as the value of their securities was increasing? Actually, if you'd had such a rule, that would have created incentive for them to push much more of their available for sale securities into the hold-to-maturity account, and it was the fact that they had all of these securities in the hold-to-maturity account that was concerning, because they couldn't liquidate those, and it was that overall position that was causing the concern about their overall solvency. So you actually would have worsened the Silicon Valley situation, most likely, by creating that incentive for them to put even more of their liquid securities into hold-to-maturity. So, how do you address that? Well, you could say, all right, well, for banks, we're going to require you to take the changes in value of both of those accounts into account for your capital. But a long time ago, the bank regulators decided, I think on balance correctly, that the regulatory accounting regime had diverged so much from the generally accepted accounting principle accounting regime that it was now that there were a lot of pathologies associated with that, and that the bank regulators would rely mostly on the on FASB standards for determining what what would be income, what would not be income. I think that's still correct. People have gone to FASB for a long time, even outside of the banking rules, to say that hold-to-maturity securities should be treated differently, and they have decided not to. Again, because it's not as simple a question as it sounds, and so until they do, I think that that balance that's currently being struck about what to do with accumulated other income or what to do with the treatment of available for sale securities is two ways of saying the same thing is correct.
Well, unfortunately, we are at time, but I want to please join me in giving a round of applause to these panelists. Thank you so much for being here. Thanks again to the Fed.
Start. Okay, welcome to our next panel. We've got a tight schedule today, so we're going to start. My name's Anil Kashyap. I'm a professor at the University of Chicago. I've got the pleasure of moderating. I want to thank Vice Chair Bowman for putting together such an excellent panel and a fantastic program overall, so thanks for including me. I'm joined by 4 people with different backgrounds and perspectives for this very non-controversial topic about the GSIB buffer. So we're going to start, I'll just go down the line here. So Steve Chubak is a managing director at Wolfe Research, one of their, leads their bank analyst team. You're going to see some of his numbers later on. You'll see why it makes a good deal of sense to have him here. Wilson Irvin, it says former chief risk officer at Credit Suisse. He wants me to remind you that that was some time ago. You might know him as the guy that I think of as inventing COCOs, really. I mean, that came by a push from the industry, and Wilson was central to all of that. He was recently at the Treasury as well, but now he's just a private citizen, so he can say anything. Al Moffett is the global treasurer at JPMorgan Chase. He's been there for 18 years and has seen many parts of the business. And then finally, Andrew Ullman is the managing partner of the DC office of Mayor Brown, but he also has worked as a Senate staffer and was in the White House at the National Economic Council. So we've got a diverse set of people here. And so without further ado, Andrew, you're up.
Thank you. Well, first of all, I want to thank the Federal Reserve and Vice Chair Bowman for organizing this conference. I really do think that such forums such as this are critical for building consensus around important policy reforms. so that they're durable and that they're well thought out. So thank you for having us today. I think it's especially important on the topic today of capital regulation, because capital requirements are the cornerstone of financial regulation, and that's critical that they're properly calibrated. So I think it's kind of appropriate that we start this discussion on the GSIB surcharge, but I think this discussion also is relevant for our larger conversation today on capital requirements, to start with understanding the statutory framework, because as much as what happens in Basel is important, what Congress does is the most important, and it sets the parameters on what policy makers can do and what they should be doing. And so to start is the key statute here governing the GSIB surcharge is Section 165 of the Dodd-Frank Act, which was mentioned earlier today. And that section requires the Fed to impose more stringent prudential requirements on bank holding companies with assets above $250 billion or more, including more stringent capital requirements. Now, Section 165 was adopted as part of Congress's effort to increase capital requirements for the largest institutions, but generally throughout the financial system in the wake of the global financial crisis. Now, what's important to note about Section 165 is that it functions to build off of the Gramm-Leach-Bliley regulatory framework that was adopted in the late 1999. Gramm-Leach-Bliley, you may remember, was the statute that allowed banks to affiliate and have with securities firms, insurance firms, and allowed holding companies to have material non-bank subsidiaries. That model is allowed for the creation of much larger financial institutions that could offer a broader range of financial services. Now, at the time Congress was debating Dodd-Frank, it did consider several proposals that would have undone the Gramm-Leach-Bliley framework, including reinstating Glass-Steagall or imposing limits on the size of bank holding companies, but it did not adopt any such reforms. Instead, what it did is through 165, it required the most complex bank holding companies, the ones most likely to have significant non-bank subsidiaries, to hold more capital at the holding company level. Implicit in this policy decision was that by requiring more capital at the holding company level, such institutions would be in a better position to address any issues with bank or non-bank subsidiaries. So this already reflects on our kind of the earlier panel talking about the leverage ratio and why having more flexibility for capital at the holding company level is a useful thing. Well, it's not only a useful thing, it's also what Congress contemplated in the statute. Now, Congress granted the Fed pretty broad discretion on how to implement these heightened prudential standards, including capital requirements. But it did impose some really important conditions. The first is it required that the enhanced prudential standards, including capital, be tailored. And tailoring's got been a kind of a buzzword that's been going around this town for a long time, but it is in the statute because Congress did want to avoid creating one-size-fits-all regulation with heightened prudential requirements, including capital. And the reason for this, one of the key reasons, was that it did not want to have these heightened capital requirements impact banks' operations of other key services, including like capital markets activity, custody services. So there was recognized that there was a cost that came with heightened prudential regulation. Second is that under 165, capital standards are to increase in stringency gradually and is appropriate in relation to the company's size, leverage, and other measures of risk. In other words, there is supposed to be a smooth application of prudential standards and capital, somewhat similar to what we have under the GSIB surcharge now. However, Congress also specified that it didn't want to have small changes in risk that would result in sharp, discontinuous changes in prudential standards. In other words, it wanted to address and minimize cliff effects that could come from having too big of buckets on the application of capital standards. Now, there's a second reason Congress also wanted to have this gradual application, and it is a little bit of the skunk at the GSIB surcharge garden party, which is, and I'm going to quote the language from the Senate Banking Committee's report on the bill that became Dodd-Frank, is that they wanted to have gradual application, quote, to avoid identification of any bank holding company as systemically significant. So current model may be a little off on that one, and certainly the late Justice Scalia would have said, well, that's only legislative history, and it shouldn't matter. He has a little point in that. On the other hand, it is very clear that Congress did not want to have any enhanced prudential regulations to clearly signify that any institution was too big to fail. Now, the third restraint and requirement that Congress put in 165 was that these capital requirements were supposed to be part of a broader range of heightened prudential standards, some which have already been mentioned today: resolution plans, stress tests, leverage, liquidity requirements, and that they were all to work together. In other words, the G-SIB surcharge was not supposed to be a big tax or a standalone capital charge that did not reflect all of the other heightened prudential requirements on institutions, bank holding companies above 250. It should all work together. So I think going forward with that framework, what it means is that there's a fair amount of flexibility, but there are some important constraints that Congress wanted the Fed to think about when it imposed these heightened prudential standards.
Okay, thanks. So before we go further, I want to I'm figuring most of you don't spend your time studying method 1 versus method 2 to calculate the G-SIB surcharge. So before we get into the further details, I'm going to just give you a little bit of background. There are two ways, two alternative formulas. There's the one that was agreed in Basel, which we're going to call today method 1, which tries to figure out the basic point here is the more interconnected you are, the higher was to be your capital standard. And there's a Basel agreement that has 5 indicators that I've listed there: complexity, size, interconnectedness, substitutability, and cross-jurisdictional activity. And you're compared based on a set of global peers each year. The Fed, 10 years ago, went in a slightly different direction for reasons that we can revisit, but there are 2 things that I think you should realize now. One is that it doesn't have exactly the same 5 indicators. It's instead probably burned by the GFC, where there are all these runs. Reliance on short-term funding is in there. There's no cap on any of these things in method 2, which is what's being used now. In method 1, the substitutability factor is capped. And then perhaps most importantly, I think Steve will talk about this when he gets there, is these 2 methods have diverged. If you just look over time, the Fed's method takes data from essentially 2012 and 2013 and benchmarks against that. And so as this banking sector has become bigger, the method 2 charges have risen. So if you look over time, this is one of these beautiful charts from this report that Stephen just put out, shows in the top method 1 and in the bottom method 2, and this is as of 2016 versus now. These things all come into effect with a lag, but you can see that there's a time trend. All the gray bars in the bottom picture are higher than the blue bars, which means over time there's been an increment, and this feeds to what Andrew was just talking about, whereas in method 1 it's been more or less flat. So when we come to these things, I hadn't seen this till I read his report. I did not realize how big the drift was that was coming from all of this. Okay, so now let's go back to regular programming. We're going to, the theme for the rest of the run of the show is each of the rest of the 3 of them will each give 5 minutes on whatever they think you absolutely have to know. Then we'll talk specifically about method 1 versus method 2 versus some other method if you want to make a recommendation. And then lastly, in a third go, any other technical fix-ups that you think are important that could be interacting with the earlier 2 panels, or just some technical fixes so that it's on the record and it's been recorded, and then we'll go to the audience. All right, so Wilson, the floor is yours.
Great, thanks, Anil. In line with the last panel, which gave us a little bit of history, because I'm of a certain age, I'm going to indulge in some history as well. What's the goal of this G-SIB surcharge? How did we get here? Pre-GFC, there was no G-SIB surcharge or large bank surcharge. The world was flat for capital. I guess our computers were simpler then, so we just did a simple ratio. So the more conceptual question for this panel is, why do we have this extra charge for G-SIBs for large banks, and how should it work? There are actually 2 origin stories for how we got here today. One argument for G-SIB was set out in a 2015 Fed paper that big banks need to have higher capital and therefore lower risk of failure because they do more damage in failure. Treasury Secretary Basel talked about a hazmat truck on the highway. That's clearly going to create more damage than a little Mazda Miata that skidded off on the side. So since the impact is bigger, we're going to want the big trucks to drive safer, and the Fed paper basically does a lot of math to equalize the expected amount of damage between a small bank failure and a big bank failure. Today, that surcharge requires about $230 billion of extra capital for the 8 U.S. lucky GSIBs, or about 3% in CET1 ratio terms. It's about a quarter of the total GSIB capital requirement here in the U.S. It's chunky, it's important, but it's only a part of a more complicated and evolving CET1 story, so we'll get into more of that a little later. There's also a second argument for GSIB surcharge, which is really separate logic. Back in about 2010, there was a senior regulator meeting over in Europe where a bunch of us big banks were told there was a temporary GSIB surcharge coming because we didn't have a too big to fail solution yet, we didn't have it funded, and until we got that, we're going to need some surcharge to reduce the risk of getting to that promised land. So the rationale for this one was centered on the too big to fail problem, which was still very confused at that time. These two frameworks never really got reconciled. The GSIB capital uplift to equity did not include any benefit for when we figured out a smoother resolution path and vice versa. So over the last dozen years, we've actually added our own form of GSIB capital in something called TLAC. Being a GSIB means you need to issue TLAC to fund your own resolution, which is a huge change compared to the drama of 2008. I was unlucky enough to sit next to Tim Geithner on Lehman weekend, and he was frankly in a lousy place. He had a $600 billion problem, and he didn't have any ammo to deal with that. His least bad option was to invite a whole bunch of banks, probably about this number of people, down to the New York Fed for some kind of lousy sandwiches and stuff, and spend the whole weekend trying to borrow capital from those banks to fund a bad bank, and then get an M&A takeout for the good bank. That didn't work. It had a lot of dance steps, and it's lousy to be in that kind of situation, to have a big bank failure on your hands, but no ammo to work with. But the resolutions that we've been designing over the last decade don't require a consortium, don't require a weekend, don't require an M&A takeout, but instead tries to self-fund resolution via TLAC debt. And TLAC today isn't a small number. It's $1.1 trillion in the United States. That's 4 times bigger than all the TARP funding that went to the big banks and got them back on their feet. And to me, this is actually the most important sleeve of GSIB capital. And that should help us mitigate to some extent some of the upward drift that you saw in that previous slide from Anil. I'd like to mention 2 other points for the big picture section. First, the real answer for GSIB equity capital buffer doesn't turn on a single component. We have a lot of components that build up into this thing. Investors and creditors care about the whole capital stack, and we have a lot of reforms in place, and figuring out exactly where that dial gets set is going to be where the rubber meets the road. If we turn all of them to the left or the right, I don't think we're going to have a very good meal. I think we'll over or undercook it. So getting that balance right and getting to a decent total number, I think, is the critical part. In the 2023 regional bank crisis, it was really, really helpful that the US GSIBs were perceived as rock solid. That crisis kind of faded from memory pretty quickly. You don't hear people talking about it very much now. And it was a much different episode than we had when the system went from small banks to medium-sized banks and to large banks in 2008. So while I think that we can do some tailoring around how steep the GSIB surcharges get, I do think that we want to be careful not to experiment with that achievement too much, because we've achieved a lot in the US by making the core of our system so much safer. 2023 raises one more point. The regional bank crisis exposed a soft spot in the middle of the US bank landscape. First Republic and SVB were $200 billion banks that fell apart quickly and cost the FDIC and then a bunch of other banks in this room a lot of money as they got charged back for those payments, and caused a lot of stress around the system. SVB even required a systemic risk exemption, which is quite an accomplishment for a bank that is so far away from being a GSIB. There are 8 or 9 non-GSIBs that are bigger than SVB today that don't have to carry either of the GSIB capital protections. Several of these are in the $500 billion range, which is coincidentally about the same size as Lehman or about the same size as Continental Illinois, the OG, too big to fail bank, if you scale it up for the size of the banking sector back then. These super regionals are clearly better run because they survived both the GFC in 2023, but unfortunately good management is not a permanent immutable attribute. So I'd argue that we have a too middle to fail issue that remains still unaddressed today, and I hope we don't have to wait for a second 2023 to learn that lesson. I wouldn't want to be stuck in Tim Geithner's rough weekend of dealing with a very large non-GSIB failure without any extra capital. So if I was going to sum all that up, I think GSIB surcharges, some of this buffer, should start a little bit earlier in the system, but we can also flatten out how it affects some of the very largest banks, and I think that would give us a good balance of the overall result. Thank you.
Al, you're next.
Great. Well, thank you. So yeah, this is a topic that's well in the weeds and well into footnotes, so we'll deal with all that part later. So I think I'm going to uptick Wilson's comment about 230. So flipping over at 4Q24, the 230 had ticked up to $250 billion. So yeah, it's a big number of capital, and really the question is this the right number, and how do we arrive at that, and is that the right distribution? Just in terms of the sort of GSIB points measurement, so which is roughly linearly aligned to the surcharge itself. So since the first year in 4Q15, that's up about 22%. Just for some comparatives, if I flip over to GDP, real GDP since then is up 24%, and so nominal GDP is up 62%. So pick your measure, but certainly the system has grown, and the largest banks have been required to hold a bit more. And before we get much further into this, I think it's really important to say that really what we're talking about is high versus very high levels of capital, and not low versus high. And I think it's an important effect. So I think that and just this week is a pretty unique one because this past Sunday was actually the 10-year anniversary of that Fed Method 2 white paper. So I encourage you to go ahead and read it. Not by me. But I think, and sort of since that framework was adopted, just remind everybody that all banks grew and not just the GSIBs, right? The surcharges are only applicable to the GSIBs, but all banks grew. The 8 U.S. GSIBs grew since then, or really for a comparative basis, just in 4Q17, the 8 GSIBs are up about 19% in score points. Admittedly, JP Morgan's up 39. The Cat 3 banks, when you think about what is the GSIB surcharge, that sort of differentiates the required capital at GSIBs versus the non-GSIBs. But the Cat 3 banks were up, meaningfully and kind of closer and well north of the GSIB overall size. So the incentives set forth in regulation do work. So I'm going to come back to this throughout the session, but I just want to make those couple of points for sort of two big reasons. So one is that the GSIB itself is a relative measure that drives additional capital between GSIBs and non-GSIBs. And two is that all banks have grown significantly in this measure. And that means the Fed should do a fundamental relook at the calibration rather than a simple rinse and repeat of the 2015 calibration. So let me just go to my first my direct sort of main 3 points here. So one, fixes are needed. We must start with the policy goals and then perform the macro calibration and go from there. So the 2023 NPR and all of the subsequent Fed speeches just simply don't go far enough to address the issue. The policy goals, when we talk about what policy things we're trying to address here, so that should really include the appropriate trade-offs between economic growth and safety and soundness, both important and needs a proper balancing. Importantly, think about designing the shapes and contours of the activities that are contained within the banking perimeter. In having to step back and looking at how do we reduce the risk of bank runs and promoting financial stability. So all these are critical, and it's important for the public to understand how this banking, this complex banking regulation is really meant to protect the system, because the whole is greater than the sum of the parts. The second big point is that diversification should be valued and not penalized. And so having diverse business model and diverse set of income streams is a source of strength for all companies, whether financials or otherwise. The third is that the GSIB surcharge is really the final and additive factor in the capital stack. And so the calibration must, and I say must, reflect the totality of all regulations to ensure it's fit for purpose. If we look at everything and make sure the cost of low-risk activities are appropriately calibrated. So as we think about the current GSIB framework, and we should keep an open mind, there are two important lenses to apply. Is that the U.S. GSIB Method 2 does provides a gold-plated differential versus the non-U.S. GSIBs. And domestically, the GSIB surcharge is a capital differential between the Cat 1s and the Cat 2, 3s, and 4s, or the non-GSIBs. For the avoidance of doubt, we support tailoring. Tailoring is important. We recognize it's reasonable for the largest banks to be held to a higher standard. It goes back to my point earlier, right? This is high versus very high, and not should we have it at all, or is it high? But the challenge is really in defining that higher standard. So the U.S. GSIBs are already subject to the highest standards of resolution planning, recovery planning, TLAC, long-term debt, as well as the most stringent liquidity risk management practices and the highest levels of capital. The capital dimension is particularly key here, since the GSIBs are also subject to an even higher SCB through the global market shock and largest counterparty defaults. So later on, we'll nerd out on the Method 1 versus Method 2. In short, and speaking as a practitioner, the Fed did some smart things with the Method 2 that helps us better manage the risks when compared to the shortcomings of the Method 1 paradigm at Basel. One important issue identified by the Fed was the clear recognition of the structural headwind due to economic growth, the infamous footnote 25. Unfortunately, this has been left unaddressed, although a temporary solution was proposed in the final rules. But all this taken together, it takes us back to my first key point, is that the Fed needs to address the broader policy goal, and we could redesign and recalibrate the GSIB surcharge accordingly. This is critical to ultimately arriving at the right capital differentials that should exist between the GSIBs and the non-GSIBs here in the U.S., as well as the differentials between the U.S. and foreign GSIBs.
Well, first, Fed Vice Chair Bowman, members of the Fed, it's an honor to speak before all of you. Thank you for the opportunity to participate in the panel. Maybe just to set the stage, I do think we need to be clear about what we're trying to accomplish with the review of the GSIB framework. And from my perspective, the goal is really to address the shortcomings with the current GSIB framework, ensure that the largest banks can remain competitive on a global scale without compromising the safety and soundness of the overall system. So it begs the question, why hasn't the Method 2 framework worked as intended? What are some of the shortcomings that need to be remedied? So I'm going to list 5 here, and I'm sure others will have different ones that come up on their top 5 list. But first is GSIB surcharge and capital volatility. When Method 2 was first proposed, the intent was to avoid the pitfalls of Method 1, including volatility in global denominators. But as we showed in the chart earlier, history has proven that the GSIB surcharges have been more volatile under Method 2 and have also seen much greater inflation, which, as Aldous mentioned, is really more attributable to economic growth versus increases in systemic risk posed by the large banks. The second point is just that Method 2 is not an accurate gauge of GSIB riskiness based on some measures. Going back to 2016, when comparing GSIB score growth versus risk-weighted asset growth, GSIB scores have inflated 3 times faster than RWA. The third point boils down to U.S. bank competitiveness. Gold plating, imposing tougher capital standards, it does create an uneven playing field. It might be the proximity to Al here. I feel like I have Jamie Dimon in my ear saying we shouldn't get complacent. We have the deepest capital markets here in the United States. It's important to protect that advantage. Fourth point is about unintended consequences. Imposing higher capital requirements, it causes a pullback in lending. It limits credit availability, but especially to low-end consumers. It also drives much more activity outside the regulated perimeter. And the fifth and final is codification. Al just alluded to this, but the intent of Method 2 was to revisit the fixed coefficients with some regularity, and I believe the exact terminology was periodically revisit. It's been 10 years, and it's been revisited 0 times. There remains no established cadence for updating coefficients, which ultimately inform the Method 2 calculations, and this is certainly something that needs to be remedied. So what alternatives would we propose? If the Fed's goal is to be more in line with international standards, ensure the largest banks are not permanently disadvantaged relative to the global peer group, then simply move to method one. To borrow from Mike Mayo's earlier presentation, it's simple and strong. If the goal is to maintain some form of gold plating and continue with some version of method two, then it does need to be significantly overhauled. The first point is coefficients. We need an established cadence for updating coefficients, and the process for updating it really needs to be codified. It'll also help address a much-needed fix to adjust for growth in the financial system. The second point is short-term wholesale funding. This is a key pillar of method two. It's grown much larger than originally intended. This should be reset to 20%. Some sort of cap should be put into place. The third point is updating GSIB buckets for new probability of default versus loss given default measures. And borrowing from Al's earlier remarks, this is certainly where one can really geek out. But the largest banks are inherently less risky today than they were 10 years ago when the Method 2 proposal was first introduced. That should be contemplated when revising some of these GSIB bands. And it also dovetails nicely with this whole notion of conducting a broader, more holistic review. So in closing, it's not clear why the US needs to continue to gold plate. I would argue the adoption of Method 1 represents a much more elegant solution. It addresses the shortcomings under the framework, and it also is simple and strong. There are real consequences also to gold plating, which have a greater impact on low-end consumers in particular, and also risk driving more activities outside the regulated perimeter. It's also worth mentioning, and I haven't heard this yet, but the solution is not always increasing capital requirements, and I cannot stress this enough. Higher capital in isolation, it's not a cure-all, it's not a panacea, as evidenced by the recent failures of Silicon Valley and Credit Suisse, both of whom had capital ratios well in excess of regulatory minimums. And in the case of Silicon Valley, was largely due to funding versus capital pressures. So lastly, if the decision is to continue to gold plate and maintain some version of Method 2, at a minimum, we need to significantly overhaul the calculation simply to ensure that it's working as originally intended. So with that, Neil, I'll pass it back to you.
Okay. So just to bang on about this to make sure everybody understands what's coming next in terms of the math. So when he's talking about fixed coefficients, there's these 5 factors, and you have to multiply the factors times some number to convert it into what's required. Those numbers under Method 2 have been fixed, okay? One of the inputs is the reliance on wholesale funding, and that number has grown, so it's got taken on more weight. And then the third consideration is that the benchmark is what share do you have relative to a fixed set from 12 years ago. Part of the reason for Method 2 was this concern that if you every year your global peers are changing and people are coming in and out of the comparison set, your capital charges could be bouncing around just because somebody goes below a threshold or some new bank comes in. And there was this concern that for capital planning, you can't have your capital standards changing by tens of billions of dollars from year to year. And so the concern, I think, that got us to Method 2 was that Method 1 was just going to be very, very unstable. We're not going to really be able to tell how it goes. And if we try Method 2 for a while and then update it, we ought to be able to get to a better place. Now, as Steve just pointed out, we haven't got there. So the first set of questions we were going to ask is just lightning round. You've already told us you'd favor going to Method 1. I don't know if anybody else here wants to take on Method 1 or say we should do something completely different, but that would be helpful. And to the extent that there is a difference of opinion, is it because you think the numbers are wrong or because you think the concepts are wrong? And then finally, former regulator here, I know that in the room that some of the Fed people will sit that bottom bullet is going to be very important, which is how much capital are you willing to release if you go down this technical calculation. Maybe we don't have to worry about it because if we do the whole thing in totality and holistically, we're comfortable. But I think we should have an open discussion about that. So why don't we just go quickly? Why don't you start, Steve, since I think. Right.
So I already let my views be known that I'm certainly an advocate for Method 1, but maybe there's just 2 quick fixes that I'd like to highlight. So let's call it a modified version of Method 1. The first is simply addressing the issue of cliff risk. The simple fact is that the buckets are too wide, and this is something actually in the latest GSIB proposal they were looking to address by shortening or tightening up those increments. I think that's a very sensible change. And the other sensible change, which actually might increase capital requirements slightly for the banks, but I think is quite prudent and sensible, is eliminate the year-end window dressing. So there should be some averaging effect which better captures how you're managing the balance sheet day to day throughout the entire year, not simply what's happening on December 31st, especially since there's always something that's unanticipated that ultimately it could pose a greater risk and drive significant volatility in balance sheets and capital minimums.
I'm going to go for a modified chewback here. If I was king or an unbridled vice chair, I would move probably to something like the UK system. They use method 1, and they also have a 1% CCYB. Now, some of you simplicity addicts in the room might say, geez, isn't that more complicated? Well, method 1 is pretty simple, transparent, it's been pretty stable, so that one is not super complicated. I know there are some weeds underneath it, but it hasn't moved around that much. But then why would you add a CCYB component? Well, we call this a GSIB buffer, but I think some of these requirements don't have a lot of buffer-like attributes. There was a Bank of England speech a while ago by Andy Haldane where he called some of these buffers concrete airbags. Those are not the most kind of fun protection devices in your vehicle. So I think if I was going to do this partly from the standpoint of overall capitalization, because if you go all the way from method 2 to method 1, that's a pretty big jump. And secondly, from giving the flexibility to people at the Fed for a COVID shock, something that's broad where you'd say, this is a time when I actually want to put some air into the system, I think having a starting point of a 1% CCYB kind of accomplishes both of those. And I don't think it's actually that complicated. Okay. Al?
Sure. So as a 2.5% method 1, who you never know how the last week of the year's FX rate's going to move, that 2.5 could quickly become 3.5%, and you don't find out until it's too late. So I would say that a lot of the work that has gone into method 2 here in the U.S. is, I think it makes, again, from a practitioner's perspective, a lot easier to manage, a lot more predictable, and there's enormous value. I think in most of these places whether it's the concrete airbags, but in general, I think you kind of want the banks and service providers and intermediaries operating in a sort of a degree of with a high degree of confidence, and that promotes continuity and availability of credit. I think that that said, if my message wasn't clear enough earlier, I do think that method 2 is just simply drifted too high, and so that should get scaled back. But so yes.
Yeah, I would agree with Al. I think the easy place to go is dealing with the drift in method 2. Again, that's very consistent with what the statute contemplated, that changes in the GSIB surcharge or heightened capital requirements would be based on risk, and that they wouldn't go up simply over time arbitrarily, and that's effectively what's happening. I also agree that reducing the buckets, again, more consistent with the statute and makes for a gradual application and gets rid of some of the cliff effects.
Yeah, I would also just flag that the Basel Committee had put forward a proposal to deal with the averaging, but the averaging only, whereas, and to address the window dressing concerns, whereas here the NPR from 2 years ago had tried to tackle the averaging and bucket sizes, so that's something that's certainly important. I think, at least for JP Chase, we've been on the record for 5 years in a very, very public way that we should do the smaller bucket sizes, that adjusting for growth, of course undoing the gold plating, but in the grand scheme of things, a lot of those mechanisms are actually net translate better to the end users in a more continuous and availability of credit.
There are a variety of questions put out in the notice about other things that could be done. I've put a few of them here, but let me just start by saying, imagine you could fix one or two other things in the framework. Is there something that jumps out at you? Some of the questions that came from the staff are, how important is it that you have a credible resolution plan? Should the board actually have to make an affirmative judgment that that's the case? If that's true, then that should substitute for some of this capital charge. Is there a way to, figure out the quality of resolution planning more generally. So those are clearly complements to each other, or substitutes, I guess. And then might there be some other interaction between what's going on with the GSIB surcharge and other objectives that are not just related to GSIB? So why don't we do another round, and then we're going to open up for questions, and I'm going to take questions in groups, and we'll see how many times we can get through. So go ahead, Stephen.
All right, I'm going to keep my comments tight because there are quite a few items I want to list here. But I already touched on window dressing. We already discussed cliff risk. With regards to some of the other fixes, I'd mentioned GSIB coefficients, short-term wholesale funding, establishing some sort of cap, and resetting back to that 20%. And then just the most technical, but I think critical element is revisiting this probability of default versus loss given default framework. The banks are just inherently much safer than they were 10 years ago. When we think about everything that's been introduced and proposed since, liquidity coverage, net stable funding, TLAC, stress testing, resolution planning, all of this provides a very effective system and checks and balances, and that shouldn't be overlooked. So in the context of what I think needs to be fixed, I think those are some areas that could be addressed. Whether we adopt method 1, some modified version of method 1 or a modified version of method 2, I think there are some obvious places that we can apply those fixes and drive some meaningful and immediate enhancements.
I'd probably make a couple of technical comments. One, I do think having a credible resolution plan and having big chunks of TLAC is important. It's a big second sleeve of capital that protects the operations of the system from the kind of collapse we saw in Lehman Brothers. So I think having that 1.1 trillion underneath you is important, and I think that should make us feel more confident that we don't need to kind of keep riding the method 2 surcharges that have been drifting up. Second point, I do think that would also be helpful in terms of this too middle to fail challenge that I talked about before. I do think there are some banks that would be really awkward to handle if, God forbid, they ran into trouble, and I think that's an important thing that we need to think about. Where do we start this system? Lastly, a brief rant. Method 2 has this short-term wholesale funding thing that is a ratio. So you wouldn't want to index that for nominal GDP growth, but it has some flaws in it. You're dividing short-term wholesale funding by RWA. So as you reduce your risk, that ratio can start to grow and grow and grow, and you get some really weird effects. Because I have weird hobbies, I was looking through some of the Method 2 scores over the U.S. landscape before today. And there were some periods where a $100 billion IHC was considered the riskiest bank in America by that score because they didn't have enough RWA to dilute that denominator and it was uncapped. And so you got these really weird effects. So I do think that is, the wholesale funding thing is an important challenge, but I think that number as it's worked out is a bad collusion. We need to fix it.
Yep, a little bit repetitive, but I think from a structural fix, smaller buckets, averaging, all good, adjust for growth, undo the gold plating, adjustments to the short-term wholesale funding, which seems to be a lot bigger than intended, and just to delve, we are on the GSIB panel, so nerd out a little bit, but inside the framework is something known as the reference bank. And so, if the largest banks grew, the so-called reference bank, which is the sort of comparative that's done and says, well, the largest banks have to hold capital relative to this reference bank, that reference bank grew too. So I think it's always important to keep in mind, like, what are we actually comparing ourselves to in this reference bank?
I'll add 2 additional areas of consideration that are broader than just the GSIB, and it kind of applies to all the heightened prudential requirements. One is that we need to be more sensitive to the other activities of the GSIBs, as Congress clearly specified in the language, and because of the systemic impact that overdoing some of these enhanced prudential requirements can have. And I think 2 I'd focus on are custody and market making. During the in the 2020 COVID shock, we saw a real problem with liquidity in the markets, and that still hasn't been fully adjusted. And the GSIB surcharge, along with all these other recalibrations, are important for helping improve that. 2 is also, remember, custody banks people run to during crises, And I'm very concerned that you've seen some activities when we have stresses where custody banks aren't able to take all of the cash that comes to them, and that there's a real problem there. Those should be, those are the types of activities that we want to encourage towards our custody banks. And they're very much a shock absorber in a crisis. And improperly calibrated GSIB surcharge can undo that nice safety valve. And also, just as a second broader point, which is follows up on the earlier panel about treasuries, is given the size of the U.S. Budget deficit and debt GDP ratios, more treasuries are coming. So it's not a question of if they're going to be ending up on bank balance sheets and other financial institution balance sheets. It's going to happen, and I think it's best to start thinking about how, rather than a lot of countries deal with large issuances of government debt through financial repression. I think we should start thinking about taking the opposite approach, which is to the extent institutions want to hold additional treasuries, we should make it easier so that there's not a disincentive for them for doing so. That will help our overall financial system. The interest rate risk, I think, is a fair thing to monitor, but that interest rate risk, though, is going to be in the marketplace regardless. Again, these treasuries are coming, and I do have a little more confidence that interest rate risk could be potentially better managed if it within the banking system.
Okay, so thank you guys for being relevant, but also on time. And so we're going to now collect some questions. So raise your hand. I see one in the back. Remember to introduce yourself.
Hi, I'm Mark Miguel, economist at the Federal Reserve. I have a question for the panel. If we are to keep the Meta 2 and we want to make it updated more dynamically, what would it make more sense to you to update it based on the size of the global financial system, like based on the global denominators, or based on the size of the U.S. economy?
Okay. We'll collect a couple more. There was one in the middle here.
Thank you. Noah Cutler from Barclays. I'm wondering if you've given any thought, or you think we should give more thought to the GSIB methodology's cousin. This is the risk-based indicators and the tailoring framework, which affect the Cat 3 and 4 banks. So as you know, like today they share cross-jurisdictional activity and weighted short-term wholesale funding. And if you went to method 1, they would only share one of these risk indicators. And so just thinking about how to make a framework that's simpler, potentially more coherent, like do you think we should, give that a little more thought, like how those tailoring categories are working for the Cat 3 and 4 banks? Thank you.
Okay, we'll take one more. Over here.
Hi, Bill Demchak, again from PNC. Just something to keep in the back of your mind as you go through the work set to do this. In 23, with the rise in interest rates and the failure of the 3 banks, one of the largest GSIBs in the U.S. came close. Wasn't publicized, but its marked capital ratio went below 3%. And you can argue the GSIB ratios, number is too high, but we had a giant bank come close. Personally, I think the fix to that goes back to EVE and some measure of actual balance sheet risk as opposed to how much capital you hold. But my point is, if you're not going to measure the risk correctly inside of a balance sheet, trying to make up a capital number is irrelevant.
Okay. All right, so we've got one question on very specific GDP or global bank size for the updating, another on tailoring, and then were we all being too rosy because we had a near miss that we don't like to talk about amongst the GSIBs. So who wants to go first?
I want the near miss. Okay, I'll jump in first. To the first question, I'd go for the size of nominal GDP. We've had periods, I lived through the 2000s when there's a lot of financialization growing through the economy, and if you had it indexed to the size of all the other banks, but all the other banks are growing like Topsy, you don't bring any extra capital in the system during that period, and the financial system can grow relative to the real economy, relative to the government. So I think it's a little bit better to tie it down to the real economy, to the thing that ultimately we all work for, as opposed to a race where you could get some strange periods of financialization that might have an effect. I'm going to dodge the RBI indicators question because I don't know anything about it. I think Bill's comment about balance sheet risk is an important one. I remember talking to some of my European friends who were making fun of us for not controlling interest rate risk in the banking book better in the United States. I hate being made fun of by those guys. It's not fun. But unfortunately, in this case, they had a point, and I think that was something that, the interest rate risk in the banking book did bring down Silicon Valley Bank. They had no equity if you mark things to market. Pretty much same thing with First Republic. And there needs, although it's a complicated question to Randy's comments, I think those guys are way over their skis. So I think there's ways you can do it in a moderate way that prevents you from skiing straight into a tree, but having a little bit of a guardrail against some of that stuff.
I'm also going to punt on the second question, if that's all right. But the first question, I do think it makes sense to link it to nominal GDP. Bill, a lot of what you said really resonates. I spent many a weekend analyzing all the bank stocks, certainly during that banking crisis in 2023. The one thing I would note is I do think that more banks, and this is just my personal view, should be subject to AFS mark-to-market. And someone was talking about the dangers of moving too much into held to maturity. I think it's also sensible to maybe contemplate a cap as to how much you can put in HTM. It could still be the majority of your securities, but it shouldn't be 90, 95%, because by the time you run out of liquidity and then you need to sell HTM securities, they're already going to be deeply underwater and you're going to have a negative TCE ratio. So you want to put parameters in place to ensure that you can avoid that type of situation. So those are two fixes that I've certainly thought about, but this is my one unique opportunity to actually opine on policy versus assess the impact on bank returns. So I figure I'd take advantage of that.
Sure. I think as far as the initial question, I would say maybe 10 years later, it's a one-off, but in resize the denominators, reset the reference bank, but then on a maintenance basis, sort of do something that's GDP based. So that might warrant it. So maybe we can have the reprise of the 10-year anniversary of the paper for part two. On the risk-based indicators, certainly sympathy. I think, again, it goes back to is that the right outcome? Where do you want to be? How do these things? I mean, I'm not the expert of should or shouldn't be, but I mean, certainly warrants a look. On the last point that Bill raised, I think it's actually. I'll do my best to take that a bit head on. I think for me, one of the lessons that came out of 23, I think this part of the rhetoric that hasn't quite made it out, into the public domain. I think one of the critical things is that whether you've got unrealized losses sitting in HTM, unrealized losses in AFS, that depending on whether or not you've got the AOCI filter in or out, at the end of the day, the most important thing is really just trying to keep track about when are these banks investable, when are they no longer investable, and when the bank is no longer investable, it's toast. It's over, right? We saw SVB try to do a capital raise. That failed. It went under. First Republic, a number of large banks, gave them, we put a deposit in, bought them some more time. They looked for an open bank solution. That was just not going to work. They went into receivership. As far as, and I think obviously there was a lot of people, certainly in the Twitter sphere, who became suddenly Monday morning quarterbacks and experts in sort of bank accounting and bank regs and AFS and HTM. I think really the key thing is that in the bank's contingency planning, in the sort of resolution planning, the critical thing is knowing, when to stop for gas, right? You drive on the highway, if you don't trust that your reserve thing is right, and my wife fills up at a half a tank and I fill up with 10 miles to go. So the thing is that, oh, sorry, it is on camera. Anyway, no, but I think, but in all seriousness, the thing that's really important is that the goal is not to have zero failures. I think the lessons from a Lehman failure was a spectacular failure, and that's the kind of lessons. Okay, we don't want that again. What we do want is to have orderly failures, and that's what the whole system has been devised at. That's the kind of message we need to promote to the public and understand that, orderly failure is a part of the system and part of the system working. In order to have those orderly failures, though, you just need to catch the falling sword at the right moment. And that, and that's really, I think that it is important that the bank that you mentioned, it was still positive, and, and when they're still positive, there's ability to do that. And I think that, really the challenge when we think about the mark on an HTM, if the intent and the ability of the bank to continue to hold those securities in HTM, it's really a bet on the franchise and the durability. But that said, it really comes down to contingency planning and the connectivity to Title I and Title II for that matter, and make sure that it's sort of caught in time. And all of these, again, all of these capital measures, whether they're real measures, shadow measures, because everybody can do them. You could do it with FAS 107 in loan accounting, and that we saw in 2023 as well. That's really needs to be all taken into account for, when to curtail activities and stop activities and to try to repair the balance sheets. But, to do that, it takes time.
I'll punt on question 2, just to be consistent. And then, global versus U.S., if you read the statute, Congress is always talking about the U.S. financial system. It wasn't concerned about the global. So there is a U.S. bias towards how the statute works. So that's probably where I'm inclined to look. But it's not
between GDP and the size of the financial system.
I don't think so. I mean, I think it comes down to, at the end of the day, I think a lot of this just backed out about where we want the numbers to end up, and that is, you want to have it as relevant as possible, but I don't have a strong view on that. On Bill's point, though, I think is really a good one in the sense of, I think all of these comments here, at least, I think should be taken in the context that 165 does require stronger heightened prudent capital requirements on the largest institutions. And you have the stress test on top of that to ensure that we have a much more resilient capital regime. And I think most of the reforms here actually will make the system more resilient and more risk-based, so that behavior by the largest institutions, particularly the G-SIBs, reflects the larger system. But again, we've got to get that right balance. There's been such an increase in capital. You can now see these adverse impacts that do need to be addressed to make sure we do have a resilient system the next time, and there will be a next time there's a crisis.
Yeah, and I think just to underscore the point that, it is important to have just confidence in the sector, confidence in management, and I think that the system is designed to hit a few speed bumps and keep going. And I think that one of the, I would say, premature critiques that often came out during 23 was that the question about the immediate mark-to-market or liquidation value. And I think it's a very unhealthy system if the entire world is conditioned to just run the world on a mark-to-market basis, because that's not what we are. There's many banks and throughout this country, that many banks with very strong, healthy franchises, and that has to count for something.
I think we have time for a couple more questions, if there's anything else that is on your mind. Wow, look at that. Okay, we'll pay a liquidating dividend. You get a 15-minute break instead of a 10-minute break. Thank you very much.
We'll let some more people trickle in, and then we'll. Well, good afternoon, everyone. Thank you so much for being with us for this day of our first ever Capital Conference. We're really looking forward to all of the conversations that we're having today, especially for what we're going to take away as we're continuing to do our work within the interagency and also with the Federal Reserve on capital, and as we're looking to the future of banking more generally. I also want to take a moment to thank our panel participants before we get started with our fireside chat this afternoon. Thank you for taking time to be a part of this important conversation as we're thinking about what regulation will look like in this space and in many others. We really look forward to engaging with you as we continue to have these discussions. But today, in many ways, is about the future of banking. And with that in mind, we'd like to now turn to another influence that's shaping innovation in finance. While innovation has always played a role in the evolution of the banking industry, it's becoming clear that new technologies are not merely incremental improvements, but potentially huge leaps that could fundamentally alter the structure and function of our financial system. One of these technologies, of course, is artificial intelligence. And I can't think of anyone who's better situated or prepared to discuss AI and the role of innovation in transforming finance and our economy more generally than Sam Altman, the chairman and CEO of OpenAI. Sam, thank you for making time to be with us today. I want to welcome you. Thank you for being here.
Thank you very much for having me.
It might be helpful just to sort of frame where we are with the landscape of AI and innovation more broadly. Would you just kind of set that framework for us?
Sure. Only 5 years ago, AI was still thought of as something that was in the distant future if it was going to happen at all. And even 2.5 years ago, which was right around the time ChatGPT launched, it still hadn't moved past the sort of nerds in Silicon Valley. ChatGPT launched on November 30th of 2022. That was even before GPT-4. And since then, the progress has been quite rapid. The adoption, the economic impact has also started to be quite rapid. Just last week, we had a model that was able to achieve gold-level performance on the IMO. This is something that I think if you told most people in the field would happen even a few years ago, they would say, absolutely not. You know, that's as good as our smartest humans that are true experts in their field. We're now hearing from scientists saying they're 2-3 times more productive. We're hearing from computer programmers that say they're 10 times more productive. It's completely changed what it means to write software. We have systems already that can perform at expert level intelligence in many, many fields. Now, they cannot operate on tasks that are as long horizon as humans can, so there's still a big limitation there. But even if progress were frozen right now, which of course it won't be, I think we still have years ahead of us for society and the economy to really digest this technology and figure out what the impact is going to be. You know, there was a saying for a long time that I thought was great and we should try to get to again, which is electricity too cheap to meter. And we didn't quite deliver on that as a society, although I think we still should. It does, in fact, look like we're about to deliver on intelligence too cheap to meter. We've been able to drive down the cost of each unit of intelligence by more than a factor of 10 each year for the last 5 years. Looks like we'll do that for the next 5 years too, maybe even more. This weekend, I used one of our upcoming models to do a computer programming task that I had wanted to do, sort of like a home automation nerd, and I wanted like the lights and music in my house to do this specific thing. I knew that before this technology, it would have taken me days to do that. I was hopeful that with this technology, given our recent progress, I'd be able to do it in hours. I was able to do it in 5 minutes. The AI did almost all of the work. This is something that, you know, just a year ago, you would have paid a very high-end programmer 20 hours, 40 hours, something like that to do. And an AI did it for probably less than $1 worth of compute tokens. So this is an amazing change, and the speed with which it has happened, the speed with which it will continue for the next few years, I think is still quite unappreciated. We weren't sure even a year ago how much further our current research roadmap was going to continue, if we're going to hit some sort of limit. At this point, it looks like we've got many years ahead of us of almost certain progress.
Well, fantastic. That really helps us frame the next conversation, which is you're talking to a room full of people in the financial industry and in banking, many of whom are already thinking about how they're going to use AI or already using AI. But how could you compare the potential for AI and productivity with other tech gains that we've seen in the past? Now, you know, I'm of the age that I was in just starting business when the internet became something that we used more broadly. So how could you kind of frame that for us? And is there an analogy that you might use to describe where we are?
I've never seen a technology revolution quite like this. You know, the historical examples are, people talk about the Industrial Revolution, they talk about the Computer Revolution. The internet did change a lot of things, but I don't ever remember something that, you know, would have cost $10,000 of knowledge work a year ago costing $1 or 10 cents or whatever it would cost now. Like, this is, you know, for my programming example from a minute ago, I think this is just unprecedented. Now, it doesn't work like that for everything. Things in the physical world, robots, whatever, that's going to take a lot longer. Like, we will, you know, maybe in 2020 it cost $10 to have an Uber drive you across town. Actually, let me say, maybe it cost $100 to have, you know, an emergency parcel service delivered across, you know, some amount of time, and it cost $100,000 to have an application written. In 2030. Maybe to have that software application written costs literally 10 cents, $100,000 down to 10 cents. And having that package delivered has gone from $100 to $1,000. And, you know, it's going to take a while for the robotics, for the full humanoid that can drive the car, take out the package, go upstairs, push the elevator button, the whole thing. That's just going to take a little while. But for tasks that can be done in front of a computer, it's quite, I don't know any precedent for what's happening. The analogy that I like the most, people say, you know, is this like the Industrial Revolution, or, you know, well, is this like something else? The one I like is this is like the transistor. The transistor was a discovery of really deep science physics that turned out to be very hard to discover, easy to understand once you understood it, completely economically transformative, and the value sort of diffused throughout all of society as a massive productivity win. But there was a short period of time where there were a lot of transistors, they're called semiconductor companies, and it was this huge boom. And most of those are now kind of like in the background. You're all using devices with lots of transistors in them. They're all over this room. We don't think about this as a transistor device or that as a transistor device. You know, we think of this as like a microphone and a computer and a screen and a camera and whatever else. But this technology was an incredible discovery. It changed what we were able to build. It became part of kind of everything pretty quickly. And you don't talk about companies much as transistor companies, except maybe companies like TSMC or SK Hynix or something like that. And in the same way, I don't think you'll be talking about AI companies for very long. You will just expect products and services to use this technology. You won't think about it that much. You will expect products and services you use to be smarter than you. And that will be a normal part of the world. Like the transistor, this is a technology that scales beautifully. So we had Moore's law with transistors. I don't think we have a name for it yet, but we have these scaling laws with AI where it just gets better and better, and we learn how to really industrialize this and put this everywhere. So I think that's the best historical analog. And we did see phenomenal productivity gains because of the transistor. But again, what we're seeing now with AI, to say nothing of like the weird cases like the fact that at some point AI can invent its own next versions and really accelerate progress even further, with what we're seeing right now, this just goes quite far.
Well, that's a great analogy, and I think when you said industrial revolution, and one of the things that we think about here at the board is the importance of understanding how labor dynamics might change as a result of that. So could you give us some your perspective on how you think the labor market and labor productivity or productivity more generally might be affected for some of the banks in the room or other industries that that might be tuning in by our live stream?
A thing that I like to remind people in our company of is no one knows what happens next. There's a lot of these like really smart sounding predictions. People make all kinds of like, oh, this is going to happen and this and the economy will go here. We have no idea. No one has that. In my opinion, no one really, this is too complex of a system. This is too new and impactful of a technology. It's very hard to predict. There are cases where entire classes of jobs will go away. There are entirely new classes of jobs that will come. And largely, I think this will look somewhat like most of history in that the tools people have to use their jobs will let them do more, achieve things in new ways. What it means to be a doctor or a lawyer or a computer programmer clearly will change, but people will still need medical care and they want to talk to a human. People still need legal advice and they'll want someone that they can trust to be on their side. People will still want computers to do things for them. But the amount that one person can do, and also the amount that we expect out of one person, will be incredible. Like all throughout history, we have these new technologies come along and people say this is the end of work, this is the end of jobs. It turns out people seem to want unlimited stuff and have a huge desire to express their creativity and be useful to people. And I'm still waiting for that promise from the Industrial Revolution that we only had to work 4 hours a week and got to, play on the beach and hang out with our kids, and here we all are. But one thing I believe is you never fight biology. Like evolution has had too long. We are too finely shaped. The sort of biological drives that we have and what it means to be human. Like technology doesn't change that. You can't beat that. And so I don't think the fundamental things that make us work and kind of animate society are going to go anywhere. And we'll probably all still be complaining that we have to work too hard, even though we're unimaginably rich. Probably if we could look from today at the people 100 years in the future, we would look at those jobs and say, those are not real jobs. You are not actually busy. You have unimaginable luxury. You have everything you could possibly need. You have nothing to do, so you're making up a job to play a silly status game and to fill your time and to feel useful to other people. And those are exactly the things that someone from 100 or 500 years ago would say about us today. And that's just the way of things. Like, I think that's great.
That's a unique vision of the future, but if we dial it back to today, as regulators, we're always very risk averse, and we're also very cautious about the way that we're safeguarding our data and ensuring that, one, we can use innovation as we're doing our work. And I know banks are very interested in ensuring that they can leverage these kinds of technologies. But the data that we are protecting in our organizations is really critical that we're able to maintain its security. So how should we think about risks? And given that we're in government and one section of government, how do you think about government uses?
So we expected that the financial sector and also the government itself were not going to be early adopters of our technology. AI, it's gotten much better, but when we first launched, the thing that the average person thought about AI is that it hallucinated a lot. I remember when we launched GPT-3, like there was this whole survey of academics who were supposed to be experts in AI, and they were like polled on what % of GPT-3 answers were like hallucinations. The real answer was like 0.1% or maybe even less. But the consensus of the academic experts was 50%. They thought half the time people were talking to ChatGPT, it was completely hallucinating something. It was obviously not true, but that branding kind of stuck with us for a while. And so we assumed that financial services, to say nothing of the government, were not going to be our early adopters. Some of our biggest early enterprise partners turned out to be financial institutions. Morgan Stanley, Bank of New York, these are major partners of ours that we're doing fantastic work with. And we were kind of like, are y'all sure? And they were like, yeah, we really want to do this. And they have figured out how to use the technology, how to structure it enough that they can rely on it for critical, many other financial institutions too, rely on it for critical processes. We are increasingly working with the government to roll out our services to lots of government employees. And a thing that someone said that stuck with me is, hey, we realize this is a new technology. We've got to put some new controls on it. But the risk of us not doing this, if we don't adopt this, the risk is that we don't continue to exist as a business. We know we cannot compete with, if we're a bank, we know we cannot compete with a new bank that is really going to build an AI-first experience and use AI for the entire stack of things. So it was one of the most innovative industries, and the adoption and rollout has worked better than I thought. There clearly are risks to mitigate. We talked about hallucinations. A new one on the horizon is what's sort of called prompt injections. The idea that once a model really becomes personalized to you and your data, someone else can kind of trick it to tell it something it shouldn't. I may know a lot of private information about you, but I understand when I can share that with him and when I can share that with her, and that I should never share it with him. And the models, that's a new thing that's happening, is the models get all of this personal information in them. So there's some work to do there, but we've been able to kind of go through these risks carefully and manage them, but really deliver a lot of the upside.
Speaking of personal information and those kinds of things, I might just pull a thread on that. And you may not know much about this, but this is something that the banking industry is really, really interested in right now, is fraud, and the impersonating individuals to facilitate fraud. Are there ways that we could mitigate that kind of activity, or that we should safeguard if there is the use of AI or identification of that type of impersonation?
Great question. I am very nervous about this. A thing that terrifies me is apparently there are still some financial institutions that will accept a voice print as authentication for you to move a lot of money or do something else. You say a challenge phrase and they just do it. That is a crazy thing to still be doing. AI has fully defeated that. AI has fully defeated most of the ways that people authenticate currently, other than passwords, but all of these fancy, take a selfie and wave or do your voice or whatever. I am very nervous that we have a significant impending fraud crisis because of this. We have tried, I think other people in our industry have tried to sort of warn people hey, just because we're not releasing the technology doesn't mean it doesn't exist. Some bad actor is going to release it. This is not a super difficult thing to do. This is coming very, very soon. And there's obviously some reports now of these sort of ransom attacks where people have the voice of your kid or your parent and they make this urgent call. That is going to get so compelling. Society has to deal with this problem more generally, but people are going to have to change the way they interact. They're going to have to change the way they verify, this person calling me. Right now it's a voice call. Soon it's going to be a video FaceTime. It'll be indistinguishable from reality. And teaching people how to authenticate in a world like that, how to think about the fraud impacts. This is a huge deal.
That might be something we could think about partnering on, the identification of those hallucinations or the intentional impersonations. I think would be a really beneficial thing to engage in. But being the parent of two teenagers, one just graduated from high school and the other's a sophomore in high school. Apparently, a lot of these kids these days are using ChatGPT and other AI to facilitate their work and to complete high school. Do you have thoughts about that and how AI can be used in a beneficial way instead of in this way for kids and with teaching?
Let me tell two stories and then I will answer that. I never met my grandfather. He died before I was born, but a story that was told to me by my grandmother was about what happened. He was very good at math. What happened when the calculator came out? And he thought, he always kind of liked new technology. When the calculator came out, math teachers at the time apparently said, "This is a disaster. This is the end of math education. If you don't have to learn how to use a slide rule or look up stuff in the logarithms books or whatever they did at the time, why bother teaching anyone math? This is, these kids are never going to learn." And it was apparently a real meltdown. And of course, what happened is with better tools, we use our brain power for something else. We start teaching calculus in high school. We start, exposing people to more advanced math. My own version of the story was when I was in junior high and Google came out. And the teachers at the high school, I heard this from the older kids, were really panicked. Because if there was this crazy new thing called Google, you didn't have to memorize facts. You didn't have to memorize the year that a certain war was fought. You could just look it up and what was the point of history class? And if you didn't have to fire up your car and drive to the library and learn to use the card catalog and then walk down and try to find this book, but someone had checked it out and then try to find some other book. You didn't have to suffer that hour. Then what was the point of learning? And I had gone to the library and used the card catalog as a little kid a little bit. And I was like, no, that's a really bad experience. I could do something better with that hour of my life. And again, what happened? So there was this brief effort at my school to ban Google and get these pledges not to use it and whatever. And then people realized oh man, we can give our students more tools and we can expect more out of them. And sure, maybe they drive to the library a little bit less, but they can use that time to think harder or come up with new ideas or do whatever. And that was really great. We expect more, we get more. The potential is higher, but the expectations are much, much higher. And I think it's the same thing now with ChatGPT. It is totally true. Back to that November 30th date when ChatGPT first came out, kind of the first mega passionate early adopters were for sure students using it to cheat on their finals or papers or whatever that December. And you had these school districts falling all over themselves to see who could ban ChatGPT the fastest. So we launched November 30th. By December 7th, some people have banned it. By December 14th, it's really careening off the cliff. Schools leave for the break, and it looks like ChatGPT is never going to be allowed inside of any educational institution again. It's a 2-week-old product. It's done. By the middle of January, you start seeing these things from principals, from superintendents, from serious high-up people in the world of education saying, actually, we made a huge mistake. This is the best learning tool ever. Our students, at least our sort of self-starting students, are using this to go learn anything. If we ban this from our schools, we're just not going to be globally competitive. And we've got to retool our curriculum because this is like the calculator. And now we have a calculator for words. So sure, maybe a take-home essay is no longer the right way to evaluate a student, but that process of learning to write an essay, that process of thinking better because you're I still write things that I never show anybody else just to organize my thoughts. That's really important. So we said, great. Now, the good news is students for sure have learned how to use this to learn better, to teach themselves to think things, to think in new ways. We're going to roll out a new way to help students learn better with ChatGPT very soon. The bad news is, on the whole, in those 2.5 years since, the curriculums have not moved as much as we might have hoped. People seem to have a lot of energy that they were going to have to start educating and evaluating in new ways, and then kind of the molasses of the education system did its thing, and we're still giving a lot of take-home essays. And I think that's a losing battle. We should be teaching people to use, give them assignments that require them to use tools like ChatGPT. Cannot be done without it, that's fine, but expect much more out of them. And I still hope we're going to get there.
Sounds like a transformation of our education system.
But it has to be. These kids are going to grow up and be adults with unbelievably powerful AI, and if we're not training them for that world, we've really missed the mark.
That's very helpful. Thank you. I'll make sure my daughter understands what our expectations are as she's finishing high school. But to move back to some things that you've talked about in the past and to move a little bit back to the business community, you've said that AI will make small businesses or it's going to create an environment for entrepreneurs that's going to be second to none. A new era, I think, is what you called it. How do you see small businesses? That's something that a number of our board members are really engaged in, and really we care about making sure that there's new business formation and that there's opportunity there for new entrants in that. How do you see that being transformed, and not just for the Silicon Valley small businesses or new entrepreneurs there, but more broadly?
So the first thing we saw with ChatGPT, as I mentioned, was students. One of the coolest things we saw pretty quickly after was everybody who worked at OpenAI started to get these stories of how people were using ChatGPT when it was still very novel in their business life. And everybody has their favorite, but I'll tell you my favorite. I was in an Uber, and the Uber driver was telling me about this amazing new thing called ChatGPT and asking if I'd heard of it. And I was like, oh yeah, what are you doing with it? And he was like, it's the craziest thing. I have this small business. It wasn't quite working, but now I have like an employee in every area. It does contracts for me. It answers my customer support emails. It helps me come up with my marketing stuff. It designs my He goes down this list. And he basically had this business running on ChatGPT. This was before it was a common thing. This was before GPT. This was an extremely early adopter. But he had figured out how to run a business on ChatGPT. And it was not like he was taking jobs from other people. Like his business just would have failed. He couldn't pay for the lawyers. He couldn't pay for the customer support people. He didn't know how to get someone to design the advertisements for him. He didn't know how to have a system that could automatically bid for ads on the internet for him. And ChatGPT just did all of this. Now, obviously, it's much better now. Now we have a whole industry around us that builds tools with our API to make people really, truly one-click automate all those things I just talked about. But the creative spirit of people that were just doing this inside of ChatGPT, way back in the Stone Age, really stuck with me. And now it feels like it's on easy mode, and people are doing that in all sorts of amazing ways.
It's really transformational, I think, for me. The first time I used it, I was trying to write a haiku for a Kampai toast at an innovation conference, which actually didn't go very well. But at the urging of my family, of my teenagers and my husband, who's involved in AI too, we tried to make it work, and then went back to the drawing board.
The new version should be much better at haikus.
Okay, great.
It's very good at creative
I'll
writing.
Think about that. But I wanted to make sure we have some time for audience questions, if you're up for that. I see Anil in the front row. If Anil Kashyap with the Chicago booth.
Hi. So I assume one of the things that financial institutions will begin doing is using this to mine their data, maybe to do credit scoring, credit evaluation. What do you say to the people that are worried that it's going to be picking up patterns and making decisions on things we wouldn't want to? And how are you guys thinking about protecting against that?
So this is deeply outside my area of expertise, so I'll answer in the general case. One of the things that is cool about these models is they understand us in natural language, and they're so steerable. So if you say, hey, you can go look at all this data to make a decision, but don't consider X, Y, or Z at all, don't let that have any factor, it generally speaking will really be good at following that. The doing this in language models is different from the way that we used to do this sort of just group all this data together into these clusters. And so you can really instruct, and it will really, really follow your intent. The second thing is, I think the question behind the question there is that these models are going to be very biased in ways we don't like. I think humans are quite biased. I think AIs are dispassionate and unemotional and don't have the kind of built up, whatever that people do. And I think it'll be possible for AI correctly built to be a significant debiasing force in many industries. And I think that's not what many people thought, including myself, with the way we used to do AI, but on the current trajectory, that seems very possible.
Hi, Sam. Stephen Scott with a company called Starling. I recently had the opportunity to interview Craig Mundy, who wrote a book with Henry Kissinger and Eric Schmidt, where they describe AI as almost the evolution of a new species. And Craig was saying that we can teach AI human moral codes, they can learn it and reflect it. So there's a lot of talk about the ethics of AI. My question for you is, will AI evolve its own morality?
I think people get very confused about whether they want AI to be a tool or a creature. And I don't, like, I'm very much in the tool camp. I don't think AI will have independent morality. I think that AI can certainly learn, really study humanity and the best of our thinking. It can probably help us point out, here's a problem in your thinking, here's a thing that should be different, here is like a real moral gap. And I don't know what the giant moral gaps are in our current worldview, but I guarantee you there are some. And if it can help us find those a little bit faster, I think that would be, if it could point out those inconsistencies, I think that would be helpful. But I think it is easy to sort of impute creature-ness on AI that is not there.
Thanks. I read recently, it's weird to use the phrase traditional internet, but there are some people who say that AI will sort of destroy or really reshape the traditional internet, whether it's search, whether it's lots of other things. And obviously there's a huge economy now that we built on that. What's your sense of the amount of change that's going to happen in that world, where AI will be most disruptive and where things will be more status quo?
I do think there are all of these things. So I think AI will be somewhat disruptive to the way people currently use technology. The reason I was smiling is there's this funny thing that happens. Older people, or people who are used to like emailing with a certain kind of etiquette, will type out the bullet points that they want to communicate, put it into ChatGPT. ChatGPT will write this long, nice, formal email with a bunch of like fluff and the bullet points somewhere in there. They'll send it across to somebody else. That person will put it back into ChatGPT and say, please summarize this for me. And on the whole, the high school students think this is ridiculous and just say, just send the bullet points. Like that kind of like formal email thing is dead. Just like, you're generating on one side, you're collapsing it back. This is ridiculous. And it's funny, but I think there's something about the way we use the whole internet that is encapsulated there. Like when I wake up in the morning, I go through a bunch of apps. I read messages across 5 or 6 different things. I go check, a thing here, a thing there, a thing there. And what I really would like, and then my phone all day long is just like blowing up at me, and it feels like I'm like walking down the Las Vegas Strip and these things flashing at me, and it's very distracting. People like shoving things in my face. And what I would like is my AI agent to be off using the internet for me, knowing when to interrupt me. It can tell when I'm, focused working. It can tell when I'm in a meeting. It can tell when I'm like got some time to think. It can override if necessary. Otherwise, it can like nicely summarize stuff, respond to things for me, pull the things together. And, I want like that bullet point condensed thing. And I don't want the fluff. And I don't have to like go around and click around, and I don't have to, respond to stuff I don't respond to. But that change is probably fairly disruptive to the way that the internet works now. And I think there'll have to be new business models that go along with that. Like, I'll have to have new ways of paying for content. I have always wanted micropayments for content on the internet. I hope that finally happens. Maybe there'll be like new ways that we actually reduce, spam and message overload with new kinds of protocols. But it does seem like we're heading towards a very different way you will start your morning with technology when you wake up.
I'm Peter Hooper, Deutsche Bank. Sam, thank you very much for prolonging a career here, or at least raising productivity as the years advance rather than seeing it drop off. You mentioned you're expecting significant job losses and significant job gains. Could you talk a little bit more about the areas and the potential disruption that could cause?
One thing I believe, just as a general statement first, is that we have no idea really kind of like how much more labor supply it would really take to meet true demand today. When you are sitting in a doctor's office waiting room for an hour, I think that just means undersupply of doctors. Or that the doctors aren't productive enough. And it would be great if the doctor's waiting around, and as soon as you get there, like they're ready to see you and they have the whole thing ready to go. Lots of other examples like this. Every time you're wasting your time in any way. Every time you're kind of clicking around the internet, can't quite do the productive thing. I think we are in an undersupply of labor to a degree that is going to look horrible in retrospect. Now, some areas, again, I think just like totally gone. I don't know if any of you have used one of these like AI customer support bots, but it's incredible. A couple years ago, you like call customer support, you like go through a phone tree, you talk to 4 different people, they do the thing wrong, you call back again, you wait through it. It's like hours of pain, ton of time on hold, and the thing that you want doesn't happen. Very frustrating experience. Now you call one of these things and AI answers. It's like a super smart, capable person. There's no phone tree, there's no transfers. It can do everything that any customer support agent at that company could do. It does not make mistakes. It's very quick. You call once, the thing just happens, it's done, answers right away. Great. Now, I don't want to go back there. And I also it doesn't bother me at all that that's an AI and not a real person. So that's a category where I would just say, you know what? When you call customer support, you're going to be talking to an AI. And that's fine. A lot of these other things, I really do want a human doctor. ChatGPT today, by the way, most of the time can give you it's like a better diagnostician than most doctors in the world. And I'll, like many people here, probably put my symptoms in and test results. And, there's all these stories on the internet of ChatGPT saved my life. And, I had this rare disease and it found it. And all these doctors didn't do it. And yet people still go to doctors. And I am not, maybe I'm a dinosaur here, but I really do not want to, entrust my medical fate to ChatGPT with no human doctor in the loop. Would anybody here rather just have ChatGPT diagnose them than a doctor? Even though you know it's better? That's quite interesting, right? So this is a class where we're going to keep doing things largely the way that we did. We talked earlier about this example of computer programmers. Again, I think it's amazing that a computer programmer is now 10 times more productive. Salaries of programmers going up extremely rapidly in Silicon Valley, so are expectations. And it turns out, I think the world wants a gigantic amount more software, 100 times, maybe 1,000 times more software. So maybe each person can now write 10 times as much software. They're going to make 3 times as much. The world will be happy because the world has running way more software. The programmers will be happy too. And I think we'll see many categories like that. Things in the physical world will keep being done by humans for a while, but when this robotics wave comes crashing in another 3 to 7 years, I think that's going to be a really big thing for society to reckon with. Yeah, that's kind of what I'd summarize it.
I think we have 2 more questions over here, and we might have time for a third, but let's go ahead. Rob, you already have the microphone. Would you introduce yourself, please?
Sure. Rob Blackwell with Interfi. We've been raised on decades of sci-fi telling us that AI is eventually going to kill us all. And since you know more about AI than arguably anybody in this room, I just want to ask you, what does keep you up at night? What are the things that you worry about when it comes to AI, and how do we prevent those things that you worry about from coming true?
I think there's 3 sort of scary categories. There's a bad guy gets super intelligence first and misuses it before the rest of the world has a powerful enough version to defend. So an adversary of the US says, I'm going to use this super intelligence to design a bioweapon to take down the United States power grid, to break into the financial system and take everyone's money. Something that would just be hard to imagine without significantly superhuman intelligence, but with it becomes very possible. And because we don't have that, we can't defend against it. So that's broad category 1. And I think that the bio capability of these models, the cybersecurity capability of these models, these are getting quite significant. We continue to flash the warning lights on this. I think the world is not taking us seriously. I don't know what else we can do there, but it's this is a very big thing coming. Category 2 is the sort of broadly called loss of control incidents, where that's kind of like the sci-fi movie. The AI is oh, I don't actually want you to turn me off. I'm afraid I can't do that, whatever. And I think that is less of a concern to me than the first category, but a very grave concern if it came to pass. There's a lot of work we and other companies do on model alignment to prevent that from happening. But as these systems become so powerful, that's a real concern. And then there's the third one, which I think those first two are sort of easy to think about and imagine. The third one is, to me, more difficult to imagine, but quite scary, and I'll explain what it is, and then I'll give a short-term and a long-term example. This is the category where the models kind of accidentally take over the world. They never wake up, they never do the sci-fi thing, they never open the pod bay doors, but they just become so ingrained in society, and they're so much smarter than we are, and we can't really understand what they're doing, but we do kind of have to rely on them. And even without a drop of malevolence from anyone, society can just veer in a sort of strange direction. When I was a kid and Deep Blue, that AI system built by IBM, beat Garry Kasparov in chess, I remember my dad saying, this is the end of chess, and no one's going to play it again. But then it turned out that actually, although the AI was better than humans, AI plus a human together was way better than an AI or the human. You know, the AI would present 10 options, and the human would pick the best one or something like that and play the move. And everybody said, oh, we have this wonderful future of man and machine together. It's all no problem, whatever. That lasted 2 months, 3 months, something like that. And then the AI got so smart that the human only made it worse because they didn't understand what was really going on, and the AI alone trounced the AI and human. It's been like that ever since. Now, another interesting part of that story is everybody was convinced in the 90s that was the end of chess, because if AI could beat humans, why should humans care? Chess has never been more popular than it is today. People love to watch chess. We're very focused on real people doing like real people things. So there was like a very interesting thing that happened there. But this phenomenon, I think, is a really big deal. In the short term, you can see it where people we call this emotional over-reliance. People rely on ChatGPT too much. There's young people who just say, like, I can't make any decision in my life without telling ChatGPT everything that's going on. It knows me, it knows my friends, I'm gonna do whatever it says. That feels really bad to me. And is a really common thing with young people. And we're studying that, we're trying to understand what to do about it. Even if ChatGPT gives great advice, even if ChatGPT gives way better advice than any human therapist, something about kind of collectively deciding we're gonna live our lives the way that the AI tells us feels bad and dangerous than a bunch of things like that. The longer term category is, you know, back to that chess example. What if AI gets so smart that the President of the United States cannot do better than following ChatGPT 7's recommendation, but can't really understand it either? What if I cannot make any better decision about how to run OpenAI, and I just say, you know what, I fully hand it over. ChatGPT 7, you are in charge. Good luck. That might be the right decision in any individual case, but it means that society has like collectively transitioned a significant part of decision making to this very powerful system that is learning from us, improving from us, evolving with us, but in ways we don't totally understand. So that's the third category of how I think things can go wrong.
I think there was one question behind you, Rob. And then I might just ask you to wrap up by helping us encourage innovation in the banking system and how you might recommend we do that.
Hi, Joe Cavatoni with the World Gold Council. I think you're kind of touching on it in your third example that you've just given. Can you give us a little bit of thinking on what you're thinking about developed markets and the benefits that come to developed markets with AI, also developing markets? Because this is potentially a level-setting phenomenon that could develop, correct?
Very much. I think it'll be a deeply level-setting phenomena. Like, you know, maybe you don't love the healthcare or the banking system in the United States, but at least you have one. You know, at least you can get financial advice, at least you can get medical advice. In a lot of the developing world, the alternative to ChatGPT doctor is not a real doctor, it's nothing at all. And then you definitely rather have this. And if this keeps getting better fast enough, maybe you just get better service in the developing world in a bunch of ways. But I am very interested in what it means to give everybody on Earth like a free copy of GPT-5 running for them all the time. Every business really enabled with this level of technology to be able to give better financial advice, to detect fraud better, to underwrite risk better. Again, watching what is possible now makes me very optimistic. In the developed world, I think the biggest challenge will be risk tolerance and regulation for very good reasons, but about how quickly do you want to adopt these things. And I think, like we've seen with a few other technologies, in much of the developing world, people will just skip a few generations. It'll feel like, mobile and the internet sort of, and they'll go right to just, we're going to run everything on AI, and we're going to deliver goods and services, at least services, at 1/100th of the cost. And I think you'll see some economies transform there very quickly. I do think that obviously I'm most familiar by far with how things work in the United States, but I do think financial services here should just be completely different in another decade. Like the way that we move money, the way that we give financial advice, the way that we think about underwriting risk. It just seems like we can so dramatically improve all of that so quickly now.
How do you see OpenAI or your services facilitating that evolution? And how can we as regulators think about what the constructs should be as we're implementing or allowing for innovation to occur?
Promise I didn't come here for the TV commercial, but we'd love to work with any of you, of course. No, whether it is us or one of our competitors, I think that just in the last 6 months, as reasoning models have really rolled out this transition from these models that could think not at all and had to give an instant response to models that can think for many seconds or many minutes. And the robustness and reliability that's come with that means that for an industry like this, I think the technology is finally really usable. And a lot of people have not tried the latest generation of models. But I think if you do, you'll be like, oh, this is like much smarter than most people. And then on the government side, I think it's the same thing. Like government has got to embrace this technology, and we'll be able to do everything better.
Well, thank you, Sam, so much for joining us. We ran a little bit over time, and I'm sure everybody's ready for lunch.
Thank you very much. Sorry for keeping you.
And I look forward to working with the ranking member of the task force, Ms. Nellie Poe of New Jersey, and with all the members assigned to this task force to empower state and local law enforcement and other first responders to carry out their missions. As we prepare to secure the major events ahead, this task force must begin by learning from past failures, both here and abroad. In the United States, we've seen deadly attacks at mass gatherings, the 1996 Olympic bombing in Atlanta, and the 2025 New Year's Day attack in New Orleans. Abroad, the 1972 Munich Olympics, which are still emblazoned in my mind, saw terrorists murder 11 Israeli athletes after exploiting security gaps. In addition, in 2015, ISIS launched coordinated attacks across Paris, killing 130. These tragedies make clear the cost of complacency, and we owe it to the American people to confront these lessons and ensure we don't repeat them. This hearing is a first step. Today's historic focus will lead us to discuss and consider, like the instance of vehicular terrorism on January 1st of this year in New Orleans, the crowd security breach at the Copa America final game at the Miami Hard Rock Stadium last year, and the Kansas City parade shooting early last year. We will also discuss the 2013 Boston Marathon bombing, which occurred during my tenure as chairman of this committee. And Commissioner Davis, it's great to see you again. We worked well together in our oversight and investigating the activities following that tragedy to find a constructive outcome so that something like that couldn't happen again. So we look forward to hearing from our witnesses on these challenges, what we can do better. More importantly, we want to know what more Congress and the federal government can do to strengthen security ahead of these major events. One clear lesson from the past attacks is the need for strong intelligence sharing. Our state and local law enforcement rely on timely information from the federal intelligence community, especially our fusion centers. With rising tensions in the Middle East and the threat of Iran-backed actors operating inside the United States, raising awareness and coordination is critical to stopping potential attacks before they happen. Earlier this month, Congress passed and the President signed into law supplemental funding for the World Cup and the Los Angeles Olympics, which will be used in part to enhance information sharing. That same information sharing is critical in stopping human trafficking, which we see, unfortunately, all too well at these events. With millions of international visitors expected, criminal networks will look to exploit. We also face a growing threat from drones. According to the NFL, there were over 2,800 drone incursions at stadiums during the 2023 season, a 4,000% increase from just 5 years prior. With minimal skill, bad actors can use these drones to launch attacks or create chaos. Yet most state and local agencies lack the authority to respond. We need to equip federal agencies so they can help the state agencies and close the gap to make these events safe. We have a lot of work to do ahead of these events. I hope this hearing is a strong first step to ensure the incidents we discussed today will never happen again, and that the United States remains a global leader in providing safe and secure experiences for citizens and visitors alike. And with that, I now recognize the ranking member of the task force, Ms. Poe, for her opening statement.
Thank you. Thank you, Chairman, and good afternoon to you, sir. I am so very pleased to be leading our bipartisan task force with you today for our first hearing. Before I start, I want to express my deepest sympathy to the victims of the attack in Los Angeles over the weekend. I pray for everyone's recovery. This tragedy, which injured more than 30 people, demonstrates how important it is for law enforcement to have plans in place to prevent, mitigate, and respond to threats, including threats that may arise outside of venues. This task force has
a deeply important mission as our country prepares to host some of the world's largest gatherings and celebration over the next 3 years. Events like the 250th anniversary of America's founding, the 78 matches of the 2026 FIFA World Cup, and the 2028 Olympic and Paralympic Games will put American hospitality on display for the world to see. I'm so excited that the final match of the 2026 World Cup will be held in Bergen County in my district. And our fan festival will be right down the road at the Liberty State Park. Congress and the executive branch must be ready to roll out the red carpet and ensure that our state, local, tribal, and territorial partners have the resources they need to ensure the safety, security, and success of these mass gatherings. As we go forward, we must keep in mind that it's not just stadiums and parking lots we need to protect. It's fan festivals, entertainment districts, bars, gathering spaces where people will be gathering to celebrate. I want to thank our witnesses for testifying. Each of you has an important perspective on lessons learned as we examine past security incidents at mass gathering events. At the 2013 Boston Marathon, terrorists detonated homemade bombs. 3 died and over 500 were injured. In February 2024, the Kansas City Chiefs won the Super Bowl and the city turned out for a massive celebration and parade. Sadly, after the parade, 2 men began arguing and shot at each other. Within minutes, more shots were fired and 1 person was killed and more than 20 people were injured. During the 2024 Copa America Finals in Florida, thousands of fans without tickets crashed the gate, jumped the barriers, and entered the stadium, bypassing security and police. And we all were devastated this year when a terrorist rented a pickup truck and ramped through a crowd on Bourbon Street, killing 14 people and injuring dozens. Our committee traveled to New Orleans to hear directly from those involved in the response. Today's witnesses are law enforcement officers who face these tragic events, and they are here to help us apply the lessons they've learned to the hundreds of mass gathering events that will unfold over the next 3 years. But we also want to take a look forward and hear about what state, local, tribals, and territorial partners need from us to prepare for the America 250 celebrations, the 2026 FIFA World Cup, and the 2028 Olympic and Paralympic Games. 2 of our witnesses today will play leading roles in the securing FIFA World Cup matches next year. Before closing, I want to just point out that while our cities prepare for these amazing, wonderful celebrations of sports and global fellowship, I think it's important for me to share that, unfortunately, the administration has cut, frozen, or slowed disbursement of DHS and FEMA grants to help city address terrorism as well as regional preparedness. Cities and state needed that money absolutely now, yesterday. I hope to hear from our witnesses how grants like the State Homeland Security Program and urban area security initiatives keep Americans safe at mass gathering events. I am also worried that the administration's treatment of immigrants have sent a message to the world that you're not welcome here. Tourism is already down across the country, and our state and local economies are suffering. If the administration's visa policies keep people from traveling to the United States for the World Cup or Olympics, our communities will indeed suffer. That's really bad policy and bad economics. Mr. Chairman, I truly look forward to working with you to make sure that our communities and law enforcement get everything that they need and that they are able to get that soon. I would also, Mr. Chairman, would ask a unanimous consent that the gentleman from Louisiana, Mr. Carter, be permitted to sit with the task force and question today's witnesses.
And without objection, so ordered.
Thank you, Mr. Chairman. With that, I yield back.
I think the ranking member, Poe, and other members of the task force are reminded that opening statements may be submitted for the record. I'm pleased to have such an important panel of witnesses before us today and ask that the witnesses please rise and raise their right hands. Do you solemnly swear that the testimony you will give before the Committee on Homeland Security of the United States House of Representatives will be the truth, the whole truth, and nothing but the truth? So help you God. Thank you. And please be seated. Let the record reflect the witnesses have answered in the affirmative. We have several witnesses. First, Sheriff Rosie Cordova Stutz serves as the sheriff for Miami-Dade Sheriff's Office since her election on January 7th, 2025. Sheriff Cordova Stutz has dedicated over 29 years to law enforcement profession. Second, Mr. Ed Davis, President and CEO of the Edward Davis Company. Don't want to put you on the spot. He's been in law enforcement for 35 years, served as a police commissioner of the city of Boston from December 2006 until October 2013. Mr. Davis led the highly successful response to the Boston Marathon bombing. The second month I was sworn in as chairman of this committee, and it's quite an honor, sir, to see you back in the same hearing room where we, I think, working together, accomplished a great deal to make this country safer. Thank you, sir. Colonel Robert Hodges is superintendent for the Louisiana State Police. On January 8th, 2024, he was appointed as the 27th superintendent of the Louisiana State Police. He has 30 years with the Louisiana State Police and previously served as an intelligence officer in the Louisiana Army National Guard Reserve. And to our last witness, I would like to yield to